investors are lacking conviction one way or another. And I think perhaps key to this will be whether or not this conflict does expand.
When you see rates move at this speed and in this quantity, you always worry that something may fall off the bus.
I think the mindset and the thought process is finally shifting after years and years of low interest rates.
Everybody's worried about their ability to finance.
We're not fully back to where we need to be to say mission accomplished.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market positive by 0.2% on the S&P on a 3-day winning streak on the S&P 500. Lisa, if you want to focus on the data, the week starts today.
PPI coming out at 8:30 a.m. ahead of CPI coming out tomorrow. It's interesting to me, though, whether the economic data is really what's driving some of the gains that we're seeing in stocks and, frankly, in bonds, which arguably is what's leading stocks, or how much this is just either a haven trade or just listening to the Fed speak or just a blow off of the top that we saw last week. Basically,
We've talked a lot about it in the last 24 hours. Fed officials becoming comfortable allowing the market to do the work for them. Then the market stops doing the work for them. I can only think of one hawk on the FOMC right now who's really pushing for more hikes, and it's Mickey Bowman,
right? Mickey
the
Bowman,
governor of the Fed,
coming out this morning. But even the hawkish hawk, seems to be dampening the tone a little bit, basically saying maybe one more hike is needed, but softening the tone around the edges. It seems like everybody has been taken a bit off guard by the rise in the long-term yields, and so there is this question of how much does that do the work for them, and then if the market gets ahead of that and then pushes yields back down, wait a second. A rate hike is back on the table.
She's sounding very lonely. This can all change today. PPI a little bit later, as Lisa indicated. CPI tomorrow. Then we'll get the bank earnings kicking off on Friday. We're on Deal Watch as well this morning. Exxon, Pioneer, talked about it for the last week or so following reporting from the Wall Street Journal. We're reporting here at Bloomberg they're very close to closing this $58 billion deal. Lisa, $250 a share, the offer.
The bigger picture here is that basically it would make Exxon the big kahuna in the Permian Basin, which is the most productive shale area in the U.S. And basically, this would allow them to act better as a swing producer. They could increase production more quickly and more agilely in response to shocks. I do wonder how much the timing of this, yes, it's because they've got a lot of money and what else are they going to do? But also, there won't be as much pushback from a regulatory standpoint, I imagine, given the fact that the U.S. would like energy independence a little bit more than maybe in previous years.
243 in the pre-market, so very, very close to that offer price, that reported offer price. We're looking out for a possible announcement as soon as this morning, so look out for that as well a little bit later. Also need to talk about LVMH, the luxury goods producer over in Europe. At one point this year, that stock was higher by close to 30%. The peak was back in spring. Then we've rolled over aggressively. It's the end of the post-pandemic luxury boom, Bramo. It's the end.
Who was it who called the top perfectly and basically said that we're going to be...
Plurimi Wealth.
Yes, Plurimi Wealth. That was perfect. He was going to be selling LVMH and Hermes. It's hard for me to get my head around this and say this is a softening in consumer trends. This is basically a normalization. It's basically, all right, you bought everything that you could. You're done. Go home.
The CFO said almost exactly that.
Exactly.
We're going back to trend, and we're all trying to work out what trend is, what normal is. Patrick Armstrong, Plurimi.
There you go.
Just a fantastic call. On this program, he talked about it, Sticking with Hermes, though, right? Getting out of LVMH.
LVMH, thank you.
We can return to that another time. The latest on day 5 of the Israel-Hamas war, the numbers coming out of this, Lisa, deeply, deeply upsetting. According to the IDF spokesman, the overwhelming majority of the 1,200 Israeli fatalities, civilians.
It's been horrific. I don't know how else to say it. This news cycle has been incredibly difficult. And I think that anyone who sees the images and sees the stories that are coming out and just says categorically that Hamas's actions were horrific, has lost touch with their humanity. There is a question of what to do next and what the U.S.'s role and what the international role is at a time when everyone is concerned about this escalating in a way that becomes protracted and very difficult more broadly.
Plenty of updates from the U.S. side of things in the last 24 hours or so. We had a passionate address from the President of the United States. We now understand the Secretary of State, Antony Blinken, will travel to Israel and Jordan from Wednesday to Friday, the State Department said in a statement that we've had in the last few hours. The United States now believes at least 20 American citizens are missing after the attack over the weekend. We still don't know the number of hostages being held. according to the National Security Advisor, Jake Sullivan. Still trying to get some clarity on a major issue.
Which just speaks to the fact that even though the death toll has been going up, the reason why is not necessarily because more people are being killed, but because more bodies are being found. There has been a discovery process in place right now that is maudlin and horrific for everybody who's involved in it, but it just shows the scope of uncertainty of who's accounted for and who isn't, and the fate of the people who may have been taken over to Gaza.
We'll try and get some clarity on the consequences of all of this. Julie Norman of UCL joining us in about 10 minutes' time. Let's turn to the price action. Your equity market on the S&P 500 positive by 0.2%. The rally continues in the Treasury market. Yields down by another 10 basis points on a 10-year. Lisa, we were thinking about 5% on Friday after the blowout payrolls report. We're back down to 4.55.
In 2 days, 0.25% drop in 10-year yields. Just to give you a sense of the size and scope, that would be the most for a 2-day drop going back to July, at some point to May. Does the data verify this? And this is sort of the true test. 8:30 a.m. we do get September PPI. The precursor, as John was mentioning, to CPI coming out tomorrow. Also ahead of that 1 p.m. auction, a $35 billion auction of 10-year notes. And it comes at a time of disinflation, yes, but skepticism about whether this will stick or whether it's transitory disinflation. I know it is headbending, but this is sort of where people are at. Today, the Fed speak does continue. Fed Governor Chris Waller, Atlanta Fed President Raphael Bostic, Boston Fed President Susan Collins. And at 2 p.m. we do get the FOMC minutes from last month's meeting, although, John, you did mention, how outdated are these? I mean, honestly, it seems like, what are we going to learn from this?
Well, I don't know, because the 10 years back to where it was, so maybe it's relevant. I've got no idea.
True. I mean, maybe it's relevant, although I guess that maybe people will glean more from the statements of some of the Fed officials. And then today is the big day when it comes to trying to choose leadership in the House. I believe that the Republicans are going to gather around 10 a.m. this morning to try to settle on a speaker. They're probably going to hold a vote with the big battle between Louisiana's Steve Scalise and Ohio's Jim Jordan.
Lisa, thanks for that. The update, the day ahead looks like that. Joining us now is Ben Gutteridge, the investment director at Invesco Investment Solutions. Ben, you seem to like equities when yields were getting closer to 5%. Do you really like them now they're getting closer to 4.50?
Well, good morning. And yes, we do. I'm aware it might sort of seem hopelessly optimistic, but our suggestion is that these inflationary trends that are in place, that inflationary pressures are abating, can continue, and coupled with some resilient growth, could be a pleasant mix for equities. Certainly some unease about that positive view, but on balance, that's where we sit.
Within the equity market, what do you like right now and why?
Well, I think based on, as I said, that marginal view on being positive on equities, we are having to take something of a barbell approach. I mean, on the basis we think, there is sort of an economic slowdown. We do like US equities, and therefore that they're considered sort of the higher quality equity market around the world. Within US equities, now that's sort of by proxy liking the sort of loosely defined technology sector. But I think we're going to have to barbell that. I mean, heaven forbid you get something of a repeat of 2022. Inflationary pressures resurgent, not least given by what's happening in commodity markets. And the energy complex could do pretty well out of that. So a bit of a barbell between, as I say, that loosely defined tech sector and energy markets.
Ben, I feel a little bit like we're playing whack-a-mole with the daily narrative, and we're trying to understand how the recent events factor into longer-term decision-making and just in general people's thought process. It sounds like you have not wavered from your views, and that really everything that we've been talking about kind of factors in, not as noise, but sort of on the peripheries to watch. Is that an accurate characterization?
Well, I think it's fair. Yeah, no, we are sort of more wedded to a longer term view. Shorter term dynamics can really leave you chasing your tail in this sort of cruel world of investing. And look, I think the risk to our view is that inflationary pressures return, and that can be a function of geopolitics, which is obviously a very harrowing story, but and also an unpredictable one. I think also we're worried about this sort of resilient growth story, the jobs market in good shape, and for these inflationary trends leading to a boost in real income. So lower inflation could lead to higher inflation through as I say, real income growth. So, look, we are cautious on this view. We're ready to move on it, particularly if equity markets are strong into the year end. That would alert us to potentially pivoting to a more defensive position. But sort of the long-term view remains supportive for equities as well.
What would make you sort of trigger that kind of view? What would you have to see to give you some sort of sense that maybe things are too strong, especially in light of the ballast that a lot of people are looking toward, which is earnings that kick off on Friday?
Yeah, I mean, I think it's signs that inflationary expectations are climbing once again. Maybe you can see that in elements of the bond market. Maybe you sort of see it in commodity prices and unfortunate developments in the geopolitical situation, even yet more unfortunate developments in the geopolitical framework. So, those are the things that give us the greatest concern. We recognise the toing and froing and the political shenanigans that are going on can sort of make hedge funds sort of put whack trades on over the short term. But over the medium term, it is, we think, inflation that's going to be underpin market direction. If it comes back, and we're watching for signals on that, that's what's going to get us more cautious.
Let's finish on the bond market move. 10-year down by 10 basis points again today. The whole curve, 2s out to 30s yesterday. Double-digit move lower. Got a 10-year yield right now of 4.55. I think it was Neil Kashkari of the Minneapolis Fed yesterday who said he was perplexed by the move in yields. Ben, have you been equally perplexed?
Well, I guess so. I mean, these sort of day-to-day moves are quite astounding and sometimes sort of quite difficult to square as one narrative sort of unfolds based on the following day's move. Look, I think we accept that bond yields have moved higher at the longer end relative to the shorter end because maybe there's some sort of supply-demand dynamics there, deficits in the face of, an inverted yield curve, therefore not much value in the long end. But likewise, I think there's an acceptance that the US economy, global economy, can probably deal with higher rates. So we're not averse to the move in general for higher bond yields. But where do we go from here? We think, whilst it could be a volatile period, that with inflationary trends continuing and abating at the margin, bond yields hover around this level, maybe move a little lower. And that isn't bad news for equities.
Hey, Ben, thanks for the update. Ben Gutteridge there of Invesco.
Pleasure.
The bear steepener turns into a bull flattener. Lots of bond market jargon there, but essentially what was taking place was the long end was selling off, yields were going higher. Now we're seeing a bigger move at the long end again, but yields are going lower. So the 2-year versus the 10-year differential drops to negative 40. That curve is flattered by about 9 basis points on the day, Bramo.
Basically, what this tells me is that the long end is just swinging around and that nobody can really understand where it's going to settle out. And there's actually more stability in the front end because Fed policy seems more certain than longer-term inflation dynamics and longer-term term premia, the idea of where the fiscal picture fits in to inflation and to investor appetite.
I couldn't have said it better myself. This is what Kashkari had to say yesterday. It's possible that rising yields may mean the Fed has to do less. What do falling yields mean? That they have to do more?
Well, potentially, right? I mean, if the yields are falling for the wrong reason, the issue is, and Mary Daly talked about this extensively and others have as well, markets and people hate uncertainty. And so what we're dealing with right now is deep uncertainty, not only about near-term economic data, but the longer-term paradigm of where we're going to settle out. And as a result, you're seeing these massive swings that are definitely just contributing to the lack of certainty that you can feel underpinning a lot of investing.
We spoke to Priya Misra of JP Morgan Asset Management in the last week. Priya made the point, maybe we should just get used to this. Bigger moves at the long end and not try and ascribe too much of a narrative to it on any given day.
The problem is this underpins so many instruments. It's
big
one
time.
thing to say that about, AMC stock. It's another thing to say that about benchmark treasuries that underpin the borrowing costs of mortgages and car loans and everything else. So at a certain point, it does have consequences longer term.
Once you start getting into the game that the Fed has got in over the last week, sort of outsourcing monetary policy to the market, and then the market says, have it back. It's not a very good game to get involved in.
At some point, the data will triumph over the game. That's
Sure.
what people are hoping for.
We get some data a little bit later. PPI this morning, CPI tomorrow. Sebastian Page at T. Rowe Price in the next hour from New York City. This is Bloomberg.
We must be crystal clear We stand with Israel. The Department of Defense has moved the USS Gerald R. Ford Carrier Strike Group to the Eastern Mediterranean and bolstered our fighter aircraft presence. And we stand ready to move in additional assets as needed. Let me say again, to any country, any organization, anyone thinking of taking advantage of this situation, I have one word: don't.
We stand with Israel. The words of the President of the United States. The assistance from America sounds like as follows. Support that arrived or would soon be on its way includes ammunition, Iron Dome interceptors, and Lisa, the world's largest aircraft carrier.
There is a real question here about where the U.S. really draws the line in terms of stepping in or not. They have said that the goal is deterrence, to deter, in particular, Lebanon and Syria and the Hezbollah factions within from lobbing some sort of attack from the north. There is a question, though, about where that red line is. And again, the big issue, when does this really escalate into something that draws in more countries and more human lives?
If you looked at the market, you wouldn't have a clue any of this was happening, would you? Looking at equities right now on the S&P, 3 days of gains could well become day 4 on the S&P 500, positive by 0.2%. Maybe you'd get a hint from this monster move you've seen in the bond market, but we were coming off the back of 5 weeks of yields climbing, and now they're falling. Day 1, day 2, day 3, yields down by 10 basis points on a 10-year, Lisa, 455.62.
Cold-hearted. That's how Jane Foley described it.
Many others have too.
And that's basically an accurate description. People are looking at money, which seems like an insignificant kind of concept at a moment of such human tragedy. And yet, if that's your job, that's your job. And that's where markets are at this moment. That said, cold-hearted markets can change on a dime if suddenly oil is affected in a more significant way.
To that point, this comes down to Iran. This is what the National Security Advisor, Jake Sullivan, had to say about the Iran question at the moment. While Iran plays this broad role, a sustained deep and dark role in providing all of this support and capabilities to Hamas, in terms of this particular gruesome attack over the weekend, we don't currently have that information. We will continue to look for it. It's a question and a question and a question that we've all been asking. Lisa, I think you and I are on the same page. When you hear things like that, is that a distinction without a difference? And that's what I know you were trying to get into with John Kirby yesterday.
Basically, what is the difference between knowing that they orchestrated something and knowing that they financed it, helped with the planning, at least on a peripheral level? Where is that line in the sand, and how much is this a lack of willingness to, and for good reason, potentially, go into Iran and to escalate in that kind of way? Because if you deem them to have a real orchestrating hand in this and you don't take that kind of action, that sends a signal too. So you've seen that reluctance both on the Israeli and the U.S. side. And how much is this that they just have decided it's unclear whether we really want to take that extra step?
The Israel-Hamas war enters day 5. Joining us now is Julie Norman, the UCR Centre on US Politics co-director. Julie, wonderful to hear from you. Allow me to offer you the chance to answer that question. Is that a distinction without a difference?
You know, I do think it's important to differentiate on this. And it's interesting to me that Israel in particular is being very cautious to pin blame directly on Iran. Again, Israel and the U.S. have long known that Iran has funded Hamas, has provided much of their weaponry, et cetera. But this operation does look to be different. And again, importantly, I think a direct pin on Iran would escalate the region very quickly. This wouldn't just be Israel and Iran as two states. It would also include all of Iran's proxy groups, Hezbollah, proxy groups in Iraq and elsewhere. And so it could just blow up very quickly. And I think both the U.S. and Israel are aware of that. And one of their goals in these coming days is going to be containment, along with, retribution and deterrence. So that's on everyone's mind right now. It doesn't mean that that Iran is not going to play into this, but I think for the short, immediate future, cooler heads are trying to figure out where exactly to place the blame and act accordingly.
Judy, walk us through the tension in that statement, the words that you just used, almost a contradiction between retribution and containment. Are those two things compatible?
Well, I think this is going to be a real challenge over the next few days, the next few weeks. On the one hand, of course, Israel wants retribution for these attacks. They want to deter a broader conflict, as does the U.S. But at the same time, you're trying to contain, again, the conflict, as we just spoke about, from spilling out, whether it's in the West Bank and Hezbollah or throughout the region, or just over the long term. And John, Israel is going to be, if they do launch a ground offensive, it's going to be very difficult. Gaza is a very highly populated urban area. You would face mass casualties for Israeli military personnel, for Palestinian civilians, which we're already seeing, and of course the dozens of hostages that are being held in Gaza. So this would be very tricky. It's also very tricky to just oust Hamas as a group. And it's very tricky to know what would be next for Gaza. So I think the road ahead is going to be challenging for Israel. We've seen these, I would say Israel-Palestine has become almost emblematic of the term cycles of violence with different kinds of acts of retribution that then lead to more acts and unfortunately civilian casualties on both sides. So that's the reality of the situation, and it's a very tough needle to thread.
Julie, given all of that, what do you make of the discussion of John Kirby of the U.S. talking yesterday about Qatar actively trying to negotiate some sort of hostage release, something that could maybe de-escalate in the way that you're talking about?
Yeah, it'll be really interesting to see Qatar's role in this. We have heard these reports of some kind of negotiations around hostages, at least around women and children and elderly, some kind of negotiation that might happen there. Qatar has been an important intermediary, I would say, between the U.S. and Israel and groups that they can't or won't negotiate directly with. And I think we're going to see that playing an important role here. Again, this question of the hostages is very much in the forefront for Israel and how they coordinate any kind of operation. It's also very much obviously in the minds of the U.S. and other countries that have their citizens being held there right now.
What are the red lines, Julie? Do we have a sense of, as Israel plans the incursion, the potential ground operation in Gaza, is there a sense of pressure being placed on Israel to show restraint in certain areas from the U.S., from other allies, as well as from Middle Eastern partners like Saudi Arabia that had previously been discussing with Israel?
Sure, absolutely. I think we heard from Biden yesterday a very committed U.S. Response to Israel. We're with Israel and really not setting any red lines at this point. We're hearing different messaging from the EU, from European partners and allies, and of course from within the region, calling on Israel to stay within the bounds of international law, within the bounds of kind of rules of war and these kinds of things in terms of proportionality and targeting of civilians. So I think this will be an ongoing conversation. I think it's a very difficult one. I think many feel a lot of aversion to talking about both sides, whereas others feel it very necessary to grieve for the civilian loss of life on both sides of this border.
Julie, when you hear numbers like more than 1,000 civilians, and then we have conversations where we talk about a proportional response, what on earth is a proportional response to what took place over the weekend?
Yeah, I think many in Israel will be asking that. And again, I think this has been, again, a situation that unfortunately time and time again has played out in the Middle East and in this Israel-Palestine conflict. Over the decades, we have seen different kinds of atrocities that, again, are then met with a response that also results in civilian casualties that then just escalate for many this kind of long-term security challenge of then getting more people involved in resistance and whatnot. So it's a very challenging path, I would say, morally as well as strategically for Israel as they try and balance what might be short-term necessities and responses with what might be real long-term strategic thinking of what does this mean for the long run and what kind of future are we setting up if we respond in a way that just fuels this conflict even further.
Julie, thank you. Thank you for your insight. Julie Norman there, the UCL Centre on US Politics. It's a phrase we've heard so many times, Lisa, over the last couple of days, a proportional response. I've got no idea what that is to what took place over the weekend.
I think that's well said. I think right now, this is the difficult moment that we're in because what is the goal at a certain point? At the same time, what does proportional response mean when we're just uncovering the scope of the terror of entire families wiped out in cold blood? I mean, some of the stories and some of the pictures are just horrific. And at the same time, it's igniting long-standing, simmering resentments and anger. At some point, how do you break the cycle?
Truly, truly tragic. The coverage will continue. The coverage of markets continues as well. Your equity market on the S&P 500 shaping up as follows on the S&P. 3 days of gains could well become day 4, up by 0.2%. The contrast between this and what's happening elsewhere could not be starker. Equities continue to rally. From New York City, good morning. The longest daily winning streak on the S&P 500 going back to August could well become day 4 on the S&P. Equity futures shaping up as follows. Equities pushing higher on the S&P 500 by 0.2%. On the Nasdaq, up by 0.3%. The sector breakdown, utilities, discretionary, reversing recent moves. Top of the pile yesterday. Off the back of this in the bond market, it continues. Treasuries rallying hard. Yields lower by around about 10 basis points on a 10-year. Just to see this all at the long end, Lisa, you talked about this. Just to see this at the long end. 10-year down by 10 basis points. Friday, we were talking about new cycle highs. 10-year, 30-year. 30-year through 5%. 10-year pushing 5%. Now back down to 455 and 472.
Is there any conviction behind this, though? I mean, that's really what I'm curious, right? Because we still have people who are saying things are too volatile to get in with any kind of narrative. This feels like, narrative ping pong, whatever you want to call it, a feeling of just deep uncertainty about the longer term kind of paradigm at a time where the data isn't really helping and there's geopolitical risk that also is creating a deep sense of insecurity.
Well, the recipe right now is 1 part risk aversion, 2 parts Fed speak. Seems to be the story of the last couple of days, right? Sure,
that's the story. Now, how is PPI at 8:30 going to really factor in? And then if we get a hot CPI print tomorrow, does it all reverse all in one day? Or do people cling to some of the other stories, right? And what's going to be the sticking point, given the fact that, maybe Fed officials are saying that they're not going to raise rates again, but they're not saying that they're going to cut anytime soon. They're not saying that that really changes their longer-term view. And if anything, on the margins, that would leave longer-term yields higher if everything else is equal in the U.S. economy.
We can guarantee you this. The intraday price action in the bond market will set the tone for the following day's conversation about the outlook for the next 12 months. Then it might change again. Let's finish on foreign exchange. The euro looks a little something like this against the US dollar. The euro in and around 106. Seen a bit of dollar weakness in the last 24 hours. Bit of a programming note. Tom Keene has gone over to Morocco for the IMF World Bank meetings. No doubt he'll be chasing down the ECB president, Christine Lagarde, Lisa, over the next couple of days.
And probably asking her just about this in terms of European weakness, stagflation, potential risk with respect to oil prices, and, of course, the best places to eat in Marrakesh.
And drink and all of the above.
Yes,
TK will find the places.
I have no doubt.
I believe he touches down a little bit later this morning. Francine got there early. Look out for Francine Lacqua's interview with Geeta Gopinath at the International Monetary Fund. Well worth checking out on Bloomberg.com. And on the Bloomberg terminal. Under surveillance this morning, the death toll from the Israeli-Hamas war rising past 2,000. President Joe Biden vowing to provide Israel full support, including shipments of munitions and intelligence assistance. 14 Americans were killed and others are being held hostage in what Biden is calling an act of sheer evil. Secretary of State Antony Blinken is heading to Israel to show a show of support. Lisa, we still haven't got that much-needed clarity on the people who are missing, the people who have been killed, and the people who are still being held hostage.
We don't have a lot of clarity about how this is going to evolve. We also don't have a lot of clarity from the Israeli side about the ground operation in Gaza, let alone what the role of Qatar and Egypt and even the United Arab Emirates is with respect to hostage negotiation and trying to come to some sort of de-escalation. Regardless, I think you asked a good question. What is a proportionate response when we see the tragedies that are unfolding? How do you put this into any framework and then say, okay, how do we move forward at a time where there is seething hatred that has really led to a lot of this?
These are the kind of phrases, Lisa, that get thrown around so much in moments like this that they cease to have meaning. I've got no idea what proportional response means. If you're calling on Israel to have a proportional response, what on earth is a proportional response when you see 1,000 civilians massacred in the way that they were over the weekend?
I don't know how you pick up and move on, and yet that is what people do. There is a point, though, that people are watching, which is where does the U.S. come into play? They are sending a big military ship that is going to get there shortly. This, they say, is for deterrence, to deter Lebanon and Syria and Hezbollah in particular, which has its bases in Lebanon, from getting involved. Where are the red lines? Where are the negotiations? Where does this become an international conflagration that does start to percolate in a more significant way?
Did you see the latest from the Swiss? Typically known for neutrality, a Swiss parliamentary committee calling on the government to label Hamas a terrorist organisation. This, as we know, the US and EU already categorised Hamas as that. But the latest from the Swiss, just moving further away from what we typically associate them with, just that neutral stance where they don't get too involved.
All of Europe is still scarred from World War II, and you can feel that deeply ingrained in a lot of the response and the solidarity that you could feel over there.
That's the latest. Much more on that, of course, through this morning. In about 2 hours' time, we'll get another read on the US economy with PPI data coming out ahead of CPI tomorrow. Later this afternoon, we'll get the Fed minutes from the latest meeting. Earlier this morning, we heard from Treasury Secretary Janet Yellen at the IMF meeting in Morocco.
I'm not saying that a soft landing is an absolutely sure thing, but I do continue to think it's the most likely path. But are there risks to this outcome? Of course there are, and global shocks are among them.
Say this almost every time Janet Yellen speaks. Was that the economist or was that the politician?
Well, at this particular speech, she was not only talking about the possibility of a soft landing, she was also talking about the potential for additional sanctions in Iran, the potential for some sort of tax on Russia's money that Europe is looking to wager. There are a lot of things that are very political that she's also talking about, and I do wonder how she's parsing those two, where oil fits into that at a moment when this administration would like to see oil prices go down, and they don't have necessarily the reserves to start really creating that situation. So how does that play, the economy play, in some of these economic but also political decisions?
Here's the latest on Exxon. Pioneer deal closing in the first half of 2024. The news just crossing now. Exxon to buy Pioneer for $60 billion. I'll share some of these headlines with you as they pour out across the Bloomberg terminal. Exxon sees the Pioneer deal closing in the first half of 2024. The board of both companies have approved the transaction. The Permian production volume would be over double at the deal close. They see the deal immediately accretive to EPS and cash flow in 2024. All those comments, Lisa, coming from a slide presentation on the Pioneer deal. We've known about this now for the best part of a week. Pioneer and Exxon getting together.
Exxon trying to really be a major player, and it would be the biggest by far in the Permian Basin, but it also highlights their desire to be a swing player, to increase their production in tandem and much more directly in terms of demand, really showing the production that you've highlighted in the U.S. at a record coming as people talk about the need to move away from fossil fuels. So there just is this interesting dynamic going on in the reality of the shale space and the oil and gas space in the U.S.
More reaction on that deal throughout the program. Just to get you an update on the price action, the pre-market, Exxon is down about 1.8%. The offer price, as we reported a little bit earlier this morning, in and around 250, 253 is the price. We're trading close to it, but still some distance, Lisa. 240 in the pre-market on Pioneer. That stock is up by about 1.3%. Much more on that story a little bit later. Joining us now is Bruce Kasman, Chief Economist and Head of Global Economic Research over at JP Morgan. Bruce, let's start with the Fed speak, which is throwing this market around big time. They're talking about outsourcing monetary policy to the bond market to do the work for them, and then over the space of 2 days, the bond market stops doing the work for them. Now, Bruce, I say this tongue-in-cheek, but I guess I kind of mean it. Does this mean now they have to do more work because we've had a 2-day rally?
I don't think the 2-day rally takes out what has been a fairly material repricing of the Fed, not to more hikes, but to holding high for long, as well as some other factors, which, as you see Fed speakers talk about, determining what that is does matter for monetary policy. But I think in the immediate decision making, the rise in yields we've seen accumulating over the last 3 months, the better news on inflation, I think that's enough to put them on a pause here that extends certainly through the November FOMC meeting, and I think more likely than not through the end of the year. But they're not, I think, necessarily done. I think where we go on inflation, how much resilience the economy shows into the new year, if we don't get inflation showing signs of moving down below 3% and the economy standing, the Fed could be back in the picture in 2024.
Bruce, is there an economic consequence from the volatility in benchmark rates? And I say this at a time where if you're seeing just massive swings in the rates that people use to determine corporate borrowing costs, mortgage rates, auto loans, credit card debt, at what point does this have an impact on the economy regardless of where those rates settle out?
Yes, I think there's two things going on here. One is if you look at the move up in yields, and even if you combine that with the move up in oil prices, we're not really getting what I think would be a material drag on growth in the near term. And in fact, we also have to take into account the very positive news we've had in financial markets, which with a lag over the summer will boost growth. But at the same time, there's a risk of disruption here. As you're noting, when things move this quickly over short periods of time, there's unrealized losses, there's potential for stress, and sometimes stress in a narrow space can broaden out. I think that is the immediate risk here. It doesn't show any signs of having been realized yet, but I think we have to watch out for it as we move through the next couple of months.
Ben Gutteridge earlier this morning was saying that ultimately inflation data will prevail, and that will be sort of the guiding light in this slew of uncertainty that we've seen. When do we get that, right? I mean, we keep talking about how every week this inflation data is going to be the most important. No, wait till next inflation data. Today we get PPI, tomorrow CPI. What could move the needle with the data that we're getting now with respect to this bigger picture where we are in the inflation story?
I actually think that's a little bit of a mistake to think that any run of a couple of months or 3 months on inflation is going to tell you where inflation is going to be in a year. We've obviously had actually 3 months of pretty good news on inflation, and we're not looking for a troubling September reading either from the PPI or the CPI on Thursday. However, I would say that what's really positive here, if you want to take that, is the fact that we've had an economy that's delivered strong growth, but it hasn't put extra pressure on inflation, not from the wage story and not from the unemployment rate, both of which sent a positive message from the Fed in last Friday's report.
Bruce, we were talking earlier, John mentioned the LVMH results that came out, and it does show a normalization, at least as the company characterized, of consumer spending. We've heard this. Where is the line between normalization and rapid deterioration in consumer spending?
I think that's a hard one. And I think part of the problem in terms of watching the economy, not just the U.S., is that we've had some very outsized gains in things as we've been normalizing from COVID depressed levels. The moderation there, which oftentimes is viewed as a sign of weakness ahead, in this case, may be sending a different message that we actually are normalizing. I think the consumers generally have pretty darn good fundamentals in terms of labor income, in terms of their balance sheets. I don't think with the consumer we're going to see any meaningful break here, anything that's going to scare us in terms of a sustained bout of weakness, unless the labor market is breaking for other reasons. I think it's actually businesses that will hold the key as to how long this expansion lasts.
Bruce, that word normal, normalizing, Lisa and I have gone back and forth on that. What's normal? What are we going back to?
Well, we're in a business cycle environment where we don't know how long this expansion is going to last. I do think that what we're seeing in the labor market in the U.S., if we want to use that as a guide, is an economy that is starting to settle towards something like 150 to 200,000 jobs, which if we're growing 1.5 to 2 would be, I think, broadly consistent with normal. The question is whether we can settle at that 1.5–2% growth rate after having had a strong third quarter. And there's a whole bunch of things, as you're well aware of, that are going on here that speak to it. But I think fundamentally, the economy is still sound. The monetary policy is restrictive, but the Fed, I think, is signaling that it wants to take a pause here. And I don't think what's happening in terms of energy markets, interest rates are probably going to break this thing. And I think we're going to continue to go here with an economy that's going to be okay, with job markets that are going to hold in. And the issue about how long this lasts is about inflation. It is about the pressure on businesses and when do they get enough pressure on them to really think about shedding jobs in a more material way. It's not going to happen in the next few months.
Constructive outlook, at least for the rest of this year. Amazing. Bruce, thank you. Bruce Kasman there of JP Morgan. Let me share again this quote with you from LVMH, the CFO. After 3 roaring years, outstanding years, growth is converging towards numbers that are more in line with the historical average. We're going back to normal, whatever that is.
I mean, that is a great question, and you asked it, as this is sort of the reason why there isn't any stability underpinning the volatility that we've seen in longer-term yields, simply because nobody knows the answer to that.
The 2023 gains have gone over at LVMH. Some gains for Pioneer. Let's talk about that. The biggest deal potentially if it closes for Exxon since 1999. $253, Lisa, per share.
How much does this really speak to the acceptance that oil is something that is going to be needed for a long time and that the U.S. is going to want to be a significant player in the space?
There is a $60 billion deal in American oil. Much more on that throughout this morning. From New York City, this is Bloomberg.
We have not seen specific evidence that links Iran to these particular attacks. Obviously, they're complicit because they have supported Hamas for so many years, but just no specific intelligence with respect to these attacks that I can speak to. There's absolutely no intention, no plan to put American boots on the ground in this conflict in Israel. But we do have serious national security interests that we have to make sure that we have the options to protect if we need to.
That's the latest from John Kirby there, the US National Security Council spokesman, speaking on balance of power with Anne-Marie and Joe Matthew. The latest from the US side of things, a passionate address from the president just yesterday. Support that has arrived or will arrive, would soon arrive, will be ammunition, Iron Dome interceptors, and Lisa, the world's largest aircraft carriers, some of which the president addressed yesterday.
Although they are confirming that their intention is for no U.S. boots on the ground, the key here is deterrence. And the key question is the next steps at a time when people are wondering whether this is going to escalate, or whether we are going to see the involvement of nations to the north of Israel, and just how much this will percolate toward Iran, which really is still the big question mark.
Let's have that discussion now. The next steps. Yohanan Plesner, the president of the Israel Democracy Institute, joins us now, an independent center of research and action dedicated to strengthening the foundations of Israeli democracy. Yohanan, fantastic to catch up with you this morning, sir. The next steps, what are they?
The way to look at the next steps are not, it's not a standard, I would say, political conflict with military means. Hamas has state-like capabilities with ISIS-like goals and ISIS-like methods. So they're using ISIS methods to massacre women and kids, and just in one community, they murdered and slaughtered about 30 or 40 babies, and beheadings and so on. So the list of atrocities goes on and on. This is what happens when you have ISIS-like capabilities of a state with ISIS goals and ISIS methods. And therefore, the only next step, or the only outcome, is obliterating, crushing Hamas capabilities, Hamas leadership. It's not about trying to contain, it's about how to obliterate. And this will be costly, it will be painful, it will be tragic, but essentially by declaring war on Israel in this way, Hamas created a zero-sum game. If you want to survive, it's either obliterate Hamas or suicide and remain a victim. And we have no intention of remaining victims of this barbaric jihadist regime.
I can only begin to understand where this comes from for you, a deeply, deeply emotional place. Yohanan, when we're talking about one of the most densely populated areas on the planet, how do you both obliterate Hamas without inflicting severe, severe damage on the civilians that live there that have nothing to do with that group?
So this is exactly the sort of the key difficulty, and you're asking a very important question, and I will answer it as head of the Israel Democracy Institute. We're the country's premier organization promoting freedom, promoting democratic values, promoting if you will, the Western way of life in Israel, in the region. And as head of the Israel Democracy Institute, I can tell you, if we want the cause of freedom to survive in this region, if we want Western interests to be looked after rather than Iran, Hamas, Hezbollah dominating the region, it will have a serious price. It will have a tragic price also with Palestinian population. Hamas situates its capabilities within the Palestinian population. They're using them as human shields. This is a war crime. They have a dictatorial regime also vis-a-vis their own population. Try speaking against Hamas in Gaza. You'll be tortured, slaughtered immediately. So they captured this population and they have to go. But citizens that won't manage to detach themselves from Hamas capabilities, from Hamas leadership, will pay a price until we're going to free Gaza and going to free them. But citizens will pay a price. And promoting the cause of the West and the ally of the West and the cause of freedom and democracy means that also when tough footage will come out of Gaza, you have to stick around, because otherwise ISIS will prevail, and we're not going to let it happen.
Putting the goal aside for 1 second, Yohanan, there's a real question, and there have been analogies drawn to Iraq and Afghanistan and the U.S.'s invasion there, and sort of this hand-to-hand combat in deeply populated areas that led to a big toll on soldiers' lives as well as civilian lives and didn't lead to resolution. What makes people think that this could be different?
Well, President Biden yesterday mentioned Israel's secret weapon in his conversation with Golda Meir 50 years ago, when we were surprised the last time in an attempt to destroy our state. And he said, we have nowhere else to go. America went into Iraq, into Afghanistan. Ultimately, it pulled out. We have nowhere to go. We're not going to pull out. And the Gaza Strip is just less than a mile from some of our communities. And we have an ISIS-type organization in Israel's backyard. This cannot stand. This will not stand. There's the more moderate Palestinian Authority in charge of the West Bank, and we have a security collaboration and security relationship. So if Hamas is removed, the Palestinian Authority can return. I might remind you that back in 2006, the Palestinian Authority controlled Gaza as well. And then there was Hamas took over, killed through the PA people from balconies, murdered them, and established a dictatorial regime within Gaza. This regime needs to go. It will be painful, it will be hard, it will be costly, but they need to go.
Yohanan, there's been a real difficulty, at least in the public discourse, separating Hamas from the Palestinian people. And in the Arab world, there's also a question about where that distinction starts to get blurred and the support of some of the other nations in the Middle East, including Saudi Arabia, that was previously speaking with Israel. I'm wondering, from your perspective, how closely aligned some of those nations in the Middle East are, or how much they're in communication as this process goes on and as they try to work toward something more peaceful going forward in the future?
Look, there's a big struggle here between moderates and radical jihadists. It's not only an Israeli struggle. Israel is, if you will, a front base of the West, of moderation, of the interest of moderation in this region. If it wasn't for a strong Israel in this region, does anyone have a doubt that Iran would have otherwise become the hegemonic state here and established a dictatorial rule, much more like they do to women in their own country? They would have done throughout the region. This is the attempt. Hamas, while I'm not saying that we don't necessarily have evidence that Iran planned this attack, but Iran pours weapons, ammunition, doctrine, ideology, finance into Hamas. Hamas is an Iranian ally. There's complete agreement about the overarching goal of killing as many Jews and destroying the Jewish state. And as a matter of fact, getting rid of Saudi Arabia and the Emirates and taking charge of the territory and resources. Can you imagine the global economy, global security, if Iran actually implements its will? So it is an Israeli interest to obliterate Hamas, but it is a global and Western and American interest to ensure that Israel does it successfully, and then to restore the dialogue with the Saudis to establish this axis of moderate states that are also in accordance with the NATO and our Western allies. So there's a big picture here. The big picture is very clear. I'm not concerned at all about the Saudis not understanding it, because their survival is at stake as well. Of course, right now it will be difficult to engage in intimate peace talks, as so many people are going to die. But Israeli policy is not derived from vengeance. It's derived from a clear, rational understanding that it's a struggle for survival with forces, with evil intentions, and we have to be very strong. And I must say, if it's okay to say here, I think President Biden understands it. He came yesterday with a historical speech, and there's bipartisan support for Israel. There's a deep-seated understanding that there's shared values and shared interests. We're going to do our part, and I'm glad that the United States is doing its bit.
Yohanan, thank you for your time today. Yohanan Plesner of the Israel Democracy Institute. A deeply emotional time Lisa.
Especially as everybody who is in Israel has seen someone called up. Difficult to know how this is going to progress, how this is going to proceed, especially given the ongoing violence.
More than 300,000 reservists called up. More coverage through this morning on Bloomberg TV and on Bloomberg Radio. Your equity market positive here by 0.2% on the S&P 500. From New York, this is Bloomberg.
Investors are lacking conviction one way or another, and I think perhaps key to this will be whether or not this conflict does expand.
When you see rates move at this speed and in this quantity, you always worry that something may fall off the bus.
I think the mindset and the thought process is finally shifting after years and years of low interest rates.
Everybody's worried about their ability to finance.
We're not fully back to where we need to be to say mission accomplished.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This bond market move is absolutely phenomenal. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. Yields down double digits, 2s out to 30s in yesterday's session. This morning, we're down another 10 basis points on a 10-year. Lisa, 455.
And why? Is it just perplexing, as Neil Kashkari says, or is there something real behind this move, whether it has to do with concerns about geopolitical risk or whether it's having to do with this idea that maybe Fed officials won't raise rates again and will take a more dovish stance, given that rates had gone up so much, and yet if they reverse too much, that creates a bit of a problem.
It's odd that Kashkari is equally perplexed, but also saying it's possible that rising yields might mean the Fed has to do less. So without any real understanding of why they're higher, they're happy to outsource monetary policy to whatever the bond market's doing?
I mean, essentially, monetary policy uses the bond market as a transmission mechanism. So if the bond market is going in a certain direction, they don't have to understand it if it basically means that credit is going to be restricted, right? I mean, this is sort of the logic behind why the bond market can do the work for the Fed, even if you don't fully understand all of the rationale behind it. I would just take a step back and say what we have heard from Ben Goodrich, what we've heard from others, is that inflation data will reign supreme. At what point, though, right?
Well, the question is whether the market move is doing too much for the Fed or too little. So it does matter the meaning behind it, and I'll explain why. If yields are up because the data's super robust, then the Fed arguably needs to do more, and maybe they can suggest that the market's doing it for them. If the yields are up because of the budget deficit, and there's some kind of concern about financing the budget of the US government, then maybe yields are rising too much, given what the economy needs. They're kind of different things, aren't they?
They're completely different things, and there is no clarity on either of them. So what is the Fed supposed to do, right? I mean, this has essentially been the message. They don't know. They don't control fiscal policy. They watch it. They can think about it. They can have their views. But if they're looking at that as a potential feature, they're looking at inflation data, still indeterminate how much it's going to go down and how quickly, and they're trying to come up with some sort of forward guidance. Well, can we just say forward guidance has gotten very muddied, and they're willing to just outsource that to the bond market?
Based on the logic of the last couple of days, the rate hike in November is back on, because treasuries have rallied so much in 2 days.
I don't know.
455 on a US 10-year. More on that without the snark, maybe. I can't promise anything. A little bit later on this hour. Need to talk about a deal. Exxon, Pioneer, the biggest deal for Exxon since the late 90s. Lisa, $60 billion deal between those two companies.
It's interesting that it's coming at a time where supposedly we would be talking about the death of fossil fuels, and it was coming at a time where people just 2 years ago, 3 years ago, were talking about transitioning to electric vehicles more fully. And when gas and crude would become obsolete. No longer, right? And there is this acceptance and desire for energy independence that is new at a time we are seeing record production in the U.S. This gives Exxon an incredible amount of flexibility in the Permian Basin.
The offer, all shared stock deal, $253. Right now trading in the pre-market at $243. Pioneer up by 2.3%. That's the price action. Let's talk about the price action elsewhere on the S&P 500. Equities stacking up as follows on the S&P. 3-day winning streak on the S&P, looking to make it 4. Up a third of 1% here. There's your move in the bond market. Big move. Yields lower. On Friday, cycle highs pushing 5%. Here we are sitting here Wednesday, 455, Lisa, 455.82.
0.25% move in 2 days. How do you start to create a financing plan based on that level of volatility? 8:30 a.m. we do get the latest in real economic data that might serve as some sort of linchpin of a more concrete view. September PPI coming out. The expectation is for some disinflation. Will it be enough to create a calm background for that 1 p.m. $35 billion auction of 10-year notes that will be a test of just how much demand there is in the market. Today, Fed speakers do line up. Maybe they will all just point to the bond market and say, check out what they have to say, because we can't explain it better than that. Fed Governor Chris Waller, Atlanta Fed President Raphael Bostic, Boston Fed President Susan Collins. And at 2 p.m., in case you want some more information from the Fed, we get FOMC minutes from last month's meeting. Will it be obsolete? Will they give a better sense of how they got to that sort of soft landing projection that some people thought was a bit of wishful thinking? And today we do have at 10 a.m., I believe, we will start to see some of the procedures to lay the groundwork for the vote for who will be the next House Speaker. The contest really is between Louisiana's Steve Scalise and Ohio's Jim Jordan. All of the discussion around the U.S. support for Israel, military aid, ongoing military aid to Ukraine, all hinges on having a functioning House. And at this moment, what was it that one Congress member said it was a 2% chance they would actually come to some sort of easy resolution based on just how contentious some of these discussions
Is
are?
McCarthy making a comeback?
I don't know. Some people are saying maybe he should, because there isn't any kind of coalescing around some of the others. Does he really want to put himself out there again? He hasn't rejected it.
He hasn't. No. He hasn't at all. Still on the table, potentially. Anne-Marie coming up in about 10 minutes' time. Joining us now is Sebastian Page, CIO and Head of Global Multi-Asset at T. Rowe Price. Sebastian, I actually want to start with a quote from the CFO of LVMH, who said after 3 roaring years, outstanding years, growth is converging towards numbers that are more in line with the historical average. Raises the question, when the revenge spend, the post-pandemic boom is over, Seb, what are we going back to?
Look, I think we're not going back to what we used to call the new normal, which was the post-financial crisis environment with low growth, low inflation, and low rates. We just conducted this study of historical regimes. And if you look statistically at where we are, given the macro data, which we have to admit is quite distorted, it looks more like the old normal, so post-80s, pre-Great Financial Crisis environment, or maybe even the post-war boom. The bottom line, one of the takeaways here is that there is oxygen for the economy and markets above 5% rates. In fact, the average 10-year for the last 60 years is about 5.8%. So, Jonathan, I don't think we're going back to the so-called new normal. This is going to be ultimately a very different regime than any of the regimes we've had before. But, you know, there is room for growth. Right now, we're holding portfolios that are broadly diversified. I know it's boring. It's trite advice. But the data is so distorted that now's actually very, very timely advice.
Well, let's get into that. You say it's boring. I actually find it interesting. How can we say the regime has changed, but we're back to the old normal with broadly diverse portfolios? Shouldn't that change too?
Well, look, the equity risk premium is definitely compressed, but let's look at both sides, Jonathan, for a second, right? Growth is surprising to the upside, and we're talking about tactical positioning 12 months ahead. We started the year with 0% expected GDP growth. We're trending towards 2%. We started Q3 with 0.5% expected GDP growth. For Q3, now we're looking at 3%. So growth continues to surprise on the upside. You have strong demand for services. ISM manufacturing are up for 3 months in a row. Fiscal is pedaled to the metal. So I think there's no reason to panic and just go to cash. But on the other hand, and I'm a huge fan of the show, I watch the show every day, everyone's talking about the lagged effects of higher rates and also the speed at which rates have risen. And that is a concern, Jonathan. We have the longest yield curve inversion in history to worry about. And you and Lisa keep asking, and it's the right question, when is it going to start to bite? So you look at both sides, you take into account the fact that the data is completely distorted by pandemic distortions, the level of money, the blob of money in the system, and you sit back and say, now's not the time to be a hero. We're about 75 basis points underweight stocks, but otherwise really close to neutral on total risk.
This raises a question about bonds as a diversifying feature, and we've been talking about that a lot. How can you make the argument that growth keeps surprising on the upside, and we do have all of this fiscal spending and potentially even more down the pike based on some of the conflicts, and then that bonds still are a stabilizing offset to stocks?
So, Lisa, it's a great question. I'm kind of a correlation nerd. I talk about it in my book. I've studied the stock-bond correlation going back decades. And in a nutshell, when you see inflation or interest rate volatility, which we're kind of seeing now, driving markets, you can expect a positive return correlation between stocks and bonds. In other words, they will move together. You get a rate shock, you get an inflation shock, both can go down together, which I think is the spirit of your question. But I continue to believe that when you get a growth shock, or like you're seeing last couple of days, a geopolitical shock, plus there's the Fed talk influencing this, but the safe asset remains U.S. Treasuries and you get a flight to safety. So the question for portfolio diversification is how much inflation volatility are we worried about? And there's other ways to protect against that, to quote unquote hedge that. And how much growth volatility or sort of recession risk are we expecting? And from that perspective, you still have a role for bonds in the portfolio. And at the end of the day, higher rates means higher long-term expected returns for bonds. But this question of what is the role of bonds is really on investors' minds at the moment, Lisa. It's an important question.
So is there a stabilizing feature through both a growth shock as well as an inflation shock or a volatility shock, as you talk about?
Yeah, now you're kind of describing the stagflation environment where you get disappointing growth and still inflation volatility. I do think there is a role. It's really a matter of which variable will dominate. And if you want to balance the portfolio, you can do things like what we're doing currently in our tactical asset allocation, adding real asset stocks and an overweight to real asset stocks, which tend to pop with surprises to the upside on inflation, which we think are still in the cards. So if you have that to balance part of the inflation risk in the portfolio, perhaps some tips, but shorter term tips, cash. Bank loans are really interesting when rates are rising. They're still doing great this year. There's credit risk there, but you can actively manage them. So you put it all together. I'm an asset allocator. I don't like to make statements that one big asset class should be taken out of the portfolio. We should go all the way to cash or all the way to stocks. It's a boring approach, but it's an appropriate approach when so much of the data is distorted.
Sebastian Page, thank you, sir. A new regime, Seb Page there of T. Rowe Price. We mentioned Kevin McCarthy. Here's a quote from McCarthy on Fox News Radio. There are a number of members who want me to become Speaker again. What I've asked them is not to nominate me. That's the official response from Kevin McCarthy, Lisa.
You can kind of understand why he might not want to be renominated after, 15 rounds of votes the first time and then being the first House Speaker ousted from office. I mean, it kind of creates...
I think it's fair enough.
A little bit of,
Let's not do that
a bitter taste in the mouth, yeah.
If you're just joining us, welcome to the programme. Your S&P 500 is positive by 0.3%. Yields are a whole lot lower, down by about 9 or 10 basis points, 455.82. Just a programming note for us in the next hour. We'll catch up with Savita Subramaniam of Bank of America on this equity market, who had recently in the last couple of months upgraded her outlook on the S&P 500, I think for the second time in 2023. So we'll get the more constructive view from Savita. Also need an update on the latest in Israel. Lisa, we'll catch up with Anne-Marie in about 5 minutes' time.
Yeah, and we have been getting some sense of how it's evolving, at least in Washington, D.C., in terms of the support being pledged. Still a question, and we keep asking this, of where the linking feature is with Iran. And that is one of the big questions because from a market perspective, that does key into oil prices in a more significant way.
Haven't seen a massive rally there.
No.
Day one, Monday, and then faded pretty quickly.
Which is right now the presiding narrative in markets seems to be this is going to be contained. This isn't going to necessarily percolate out. And there will be some measures that will come in and de-escalate because otherwise you would see a more material move and it just has not stuck. The only move that's stuck is in the bond market.
That's taken the temperature, I think, of one question, whether Iran is directly implicated in what took place over the weekend. Don't you get that feeling based on the moves we've seen?
Basically the fact that Israel and the U.S., to build on that, have it come out and said Iran was directly involved. And if they haven't done that, if they're not going to get directly involved, it just takes some of the potential heat out of the pressure there.
More on that question up next on this program. Bloomberg's Anne-Marie Jourdain in Washington, D.C. Live from Washington, next.
Congress returns, we're going to ask them to take urgent action to fund the national security requirements of our critical partners. The United States has also enhanced our military force posture in the region to strengthen our deterrence, and we stand ready to move in additional assets as needed.
The President of the United States speaking on the Israel-Hamas war, addressing the country and the world just yesterday. From New York City, welcome to the program. Plenty of price action to talk about elsewhere on the S&P 500. Three-day winning streak could well become 4, up a third of 1%. The fate of this rally may be in the hands of the PPI data a little bit later this morning. Lisa will get that information in a little more than an hour. Then it's on to CPI tomorrow. And then we can start talking about earnings. Start talking about earnings, which have kind of crept up on us over the last couple of weeks.
Do you think that the PPI and CPI data is going to be more important, or JP Morgan earnings and all of those that come subsequently?
Don't know. Don't know. I really don't know.
Because right now it feels like there are so many questions that are embedded in some of the economic data that's backward looking, and the forward looks from some of these companies that have been upgrading their estimations for their own businesses might provide more of a compass than some of these lagging economic indicators.
So the banks finance the economy, and if the banks are struggling to do so, if they're constrained by what's been developing in the bond market, that's worthy of interest. I find the earnings from Bank of America perhaps more interesting than what we're going to hear from JP Morgan on Friday. B of A has had a terrible year through 2023. Their stock is down by something like 20%. So we're not talking about regional banks. We're talking about Bank of America down 20% on a year where the economy, we're told by everybody, is doing better than good, better than expected, that's for sure. Rates have been high, which is meant to help them. But it's been hurting them, and hurting them big time if you're looking at the stock.
RBC Capital's Gerard Cassidy put out a note this morning where he basically was saying he's looking for credit deterioration, which he's expecting to see some of. At what point does that lead to what you're talking about, real weakness that you're seeing in the share price of Bank of America that hasn't yet been reflected in the mainstream feeling about where we are in terms of credit retreat from the global economy?
This at the moment is just absolutely nothing compared to what we've got to talk about next. Looking at some of these numbers and still trying to get clarity on certain issues, just allow me to work through some of this. Israel Defense Forces spokesperson said the overwhelming majority of the 1,200 Israeli fatalities were civilians. We're still trying to get clarity on so many different things. The number of civilians, the number of people missing, particularly from America, their questions being asked of this president. How many are still being held hostage? I have to say that in an interview earlier on today, a reference was made by a Bloomberg anchor to the alleged mutilation of babies, which is an absolutely shocking story. We should make it clear that these are unsubstantiated reports, and we apologize for that error, but seeking clarity on some of these reports is a big, big deal for us over the next few days. Anne-Marie joins us now, our Bloomberg Washington correspondent. AMH, how on earth do we get clarity on those kind of things?
Well, right now, Jonathan, what we're witnessing is this fog of war and a ton of confusion, as you do have the IDF, the Israeli Defense Forces, going in, trying to figure out, going into people's homes. Those people are no longer there. What happened? Who is missing? Are they dead? Were they taken hostage? There's a number of questions that are happening. There's a ton of reports that are coming out of southern Israel, as well as what is going on in Gaza, and it's going to take weeks, if not months, to really try to understand the devastation and travesty that was done here. And when it comes to tracking down these individuals, you know, this is going to be really a global effort, because there were other nationals there besides Israelis. We know Americans are missing, but the U.S. can't even say how many we think are taken hostage. We just do know a number are missing.
John and I have been talking about how there's been really delicate messaging around the involvement of Iran, particularly from the U.S. and Israel, and how that will determine the involvement there. We did hear from Janet Yellen, Treasury Secretary, earlier this morning that the idea of more sanctions is on the table. Where are we in terms of understanding how far that investigation into Iran's involvement is from the U.S., from Israel?
Well, it does seem like the intelligence services are trying to go back and figure out what the direct link was. It is a very difficult line for the United States to walk, frankly, because you have to say that on some level Iran was complicit for their decades of support of Hamas, which the U.S. designates as a terrorist organization, complicit in terms of helping them manufacture arms, the amount of cash they support Hamas with, and the training that they give to this militia, again, that the U.S. designates as a terrorist organization. So on one level, The United States has to say they are complicit. At the same time, you're finding it very difficult for an official to come out and directly link the weekend's massacre to Tehran directly. And part of that reason, of course, is if Iran is directly implicated, Israel is going to be compelled to attack Iran. And I'm not just talking about deniable missile attack here or there or cyber attack, compelled to attack in a very public, forthright way. And then that, of course, risks a broader regional conflict with Iran, a major state actor, at play.
There's also a question, Anne-Marie. President Biden talked about additional aid to Israel and providing munitions and additional support. Where is the financing going to come from if there isn't some sort of speaker determined by November 17th?
Well, already, I believe the New York Times this morning is reporting that alongside Antony Blinken touching down in Israel, we will see the first tranche of weapons being delivered to Israel. There's a number of drawdown methods and money already appropriated that the U.S., the president can draw upon to send to Israel. But yes, he did call for the fact that when Congress is back, there's going to have to be more money for the intelligence and security of our partners. Notice the president used the word partners. Right there in that moment, he was linking Ukraine aid with Israeli aid. What we know is that the Senate is ready to move on this. There's a tremendous amount of bipartisan support in Congress, on the House side and on the Senate side, to make sure that Israel is given this aid and that the U.S. is standing with Israel. Of course, there's the issue of the fact that there's no Speaker of the House at the moment. But the pro temp Speaker, Patrick McHenry, did insinuate to Politico yesterday that if the government needed to act, he could. So there is a way potentially for Congress to give him the power to bring a critical piece of legislation on the floor, even though at this moment he's acting as the interim speaker and they have yet to decide on their permanent Speaker of the House.
Anne-Marie, there was a sense on Monday morning, after these shocking images over the weekend, that we would get a sense of urgency out of Washington, D.C., that maybe we'd even see a change of course, a change of approach to making policy and start to do something about the dysfunction that has plagued the nation's capital for much of this year and for a whole lot longer. Do you sense that still this morning?
I think there is this feeling that they want to act and get it together. The issue is this party, the Republican Party, has such a slim majority in the House of Representatives, and they're just too divided at the moment to coalesce around anyone. What we heard from Congressman Tom Massey of Kentucky coming out of yesterday's caucus was there's a, quote, 2% chance that today they will know who their next speaker is. Today they'll be taking a blind vote, and when they meet this morning, this is Republican caucus, and he says there's a 2% chance. So that says to me that this family has a lot of issues to work out, and we are not going to see that anytime soon. Even though when you talk to people and you hear what they say to the press, they want to act, they want to move past this, they want to get legislation to the floor. But it's just too divided, and the majority is just too slim for them to be able to coalesce around any individual at this moment.
Anne-Marie, appreciate the update. AMH down in Washington, D.C., our chief Washington correspondent. Do you think that the odds of electing a speaker are higher based on the events we've seen? A sense of urgency, the odds of a shutdown are lower? Terry Haynes-Pangaea, caught up with Terry yesterday. You're wrong. Just flat out, you're wrong. He does not think it's going to change that at all.
And that's certainly what we saw overnight, right? That's what we saw with respect to the wrangling and the lack of coalescing around a particular candidate. That said, one of the key swing factors here is at what point will Democrats want to help out in some way and not just vote for Hakeem Jeffries and try to facilitate the next speaker in some way by cutting side deals. A lot of people think that that actually might be one of the determining features going forward.
Lots still to talk about this morning. We've got a big deal in the oil patch, a $60 billion tie-up between Exxon and Pioneer, $2.53 per share. All-stock deal, the offer for Pioneer, that could close, and we could have an absolute monster at the energy patch. Exxon, potentially, with the biggest deal going back to 1999. I say potentially, Lisa, because we're still trading at $2.43 in the pre-market for Pioneer.
You can always sort of count for some risk, some tie-up risk, but still, it seems like people are baking this in, and then the question is, who's next?
Who is next? Who's going to strike a deal that big? I don't know if anyone's going to strike a deal that big. Coming up, Kathy Jones, Charles Schwab on a big bond market rally. 3 days of gains on the S&P 500 could well become 4. Day 3, the longest daily winning streak on the S&P 500 going back to late August. Day 4, equities up 1/3% on the S&P. Futures higher on the Nasdaq, up by 0.4. The Russell, the small caps, doing okay, up by 0.2%. Talked a lot about the sector outperformance we saw yesterday. Utilities, discretionary, the kind of things that were getting beaten up by higher yields, taking some comfort from lower yields. Let's see if they do that again today. 2-year, 10-year, 30-year. Let's break it up as follows. The 10-year right now, 456, down 9 basis points. The cycle high on Friday, 488.52. The 30-year right now, 472.67, down 10 basis points. The cycle high on Friday, 5.05%. And by the way, we were closed on Monday. So these moves, Tuesday and this morning, they are monster moves, Lisa. Double-digit moves at the long end of the curve, 2 days in a row.
Which makes me think, what's behind this, right? I mean, is this something that's technical? Is this someone being squeezed out of positions? Is this something fundamental that has to do with the haven demand or has to do truly with Fed speak? I don't know the answer. I don't think anyone does. Even Neil Kashkari, he finds it perplexing.
And last week, I think we had double-digit moves 2 days in a row in the other direction.
Exactly.
So go figure.
Exactly, which raises the question of structurally what's going on in a bond market that has been the most liquid, deepest market in the world. What's going on there?
What is going on? I'd love the view from the rest of the world. So we have the IMF World Bank annual meetings taking place over in Marrakesh, Morocco. TK, as I'm sure many of you know, has got on the plane. He's just messaged me a moment ago. Did you get the picture message?
He arrived.
With a picture of a camel and someone in the desert who isn't
He's
Tom.
not Tom Keene.
It's not Tom.
He's definitely not riding a camel.
I'm not sure if Tom fits on a camel or not.
I'll leave that
we'll
there.
see. TK can have a go a little bit later. Tom's going to catch up, hopefully, with the ECB President Christine Lagarde a little bit later on this week. So we'll get some questions. I'd love an international perspective on the move we've seen in treasuries.
And how difficult it makes their job, because when the U.S. Treasury market is flipping, flopping, you see that the rest of the world is moving along in tandem. It kind of muddies a message at a time that's really, I would argue, more fraught for Europe right now than the U.S., especially with people saying that, the U.S. strength is unique in just how persistent it is.
Let's take a look at Europe and Christine Lagarde's euro. The euro against the dollar shaping up as follows, just in and around 106. Broke that a little bit earlier again. Seen that a couple of times in the last few days. 105.98. We're negative on that currency pair by about 0.07%. Under surveillance this morning, the death toll from the Israel-Hamas war rising past 2,000. The Israeli military reportedly responding to missile strikes from the Iran-backed Hezbollah across the border in Lebanon. Prime Minister Benjamin Netanyahu and opposition leader Benjamin Gantz are in current talks to form an emergency government to focus on security challenges. This was a question we were asking Monday morning and through the weekend, Lisa, whether those security challenges go beyond the Gaza Strip. We have to start being concerned about what's happening in the north with Lebanon and Hezbollah coming down.
And there have been a number of reports about rockets being fired. It hasn't seemed to move into the escalation phase. Interesting, though, at a time heading into this where there was really unprecedented debate and clashing within Israel itself and the government about what kind of rule they want, right? A lot of protests to Netanyahu's rule. There's a question now, okay, coalescing around emergency government, how that factors into what happens next, especially given some of the dissents that we heard earlier.
To be clear, the bond market rally that we've seen, one part risk aversion and 2 parts this, the Fed speak that we've heard over the last couple of days. The San Francisco Fed President Mary Daly saying on Tuesday, a 5% policy rate is not the new neutral, but we may have to live with higher rates than before the pandemic. The rise in yields may also be doing the work for the Fed. Bond yields have tightened meaningfully. Financial conditions have tightened, depending on whether it unravels or whether the momentum in the economy changes. That could be equivalent to another rate hike. You caught up with Mary Daly. It's a repeat of what she told you, Lisa, last week.
And what she also said is markets hate uncertainty. People hate uncertainty, and this is uncertain. So what guidance can she give? She said, honestly, uncertainty is a policy choice. Inaction is a policy decision, because right now at every meeting, they are taking active decisions given the uncertainty. And the fact that she's parsing through, the different anecdotes, which she doesn't call anecdotes, she calls them qualitative data because she quantifies them in a more material way. But that also is part of what's factoring into how she's picking up where we are in the cycle.
They're anecdotes.
They are totally anecdotes. She said that it's different. She went off on this because, I said,
I'd love
about
to hear
Patrick.
That one day.
Well, no, but okay, well, we cannot do it now. That's what I gather.
We'll skip that today.
Yes, exactly.
Get some Fed minutes and load of anecdotes a little bit later. 2 p.m. Eastern time.
data.
Look out for that. Want to finish on this. Big deal for American oil. ExxonMobil agreeing to buy Pioneer Natural Resources for nearly $60 billion at $2.53 per share. This marks Exxon's largest acquisition since merging with Mobil all the way back in 1999. It also puts Exxon in position to become the dominant producer of shale oil in the Permian. Tune into Bloomberg TV 9:40, an interview with Exxon CEO Darren Woods, Pioneer CEO Scott Sheffield, Alex Steele catching up with both of them. Darren Woods wanted something to buy. Scott Sheffield was retiring and perhaps was looking for something to sell. It's a match made in heaven, Bramo, for American oil.
The timing is interesting, though, especially when oil is such a focus when it comes to where that's going to play with respect to inflation, as well as, the U.S. and their independence, given some of the concerns internationally. The fact that you have one major player suddenly in the shale patch suddenly might be more amenable to regulators and to all of the others in the U.S. if that is a more desirable goal than it was, say, 2 years ago.
Looking forward to that interview, those conversations in a couple of hours' time on Bloomberg TV. Look out for that on Bloomberg Radio. With us around the table here in New York, Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, wonderful to catch up with you. We spoke to a guest yesterday, Charles Cantor of Neuberger Berman, who said that bonds are contracts and equities are stories. I don't want to talk about stories in the bond market. I want to talk about price action. The first 2 days of last week, we had something like double-digit moves, yields higher. And then the first 2 trading sessions of this week, we've got double-digit moves, yields lower. What do you make of just the magnitude of the intraday moves we're seeing in the bond market?
I think Lisa touched on it. The liquidity is not what it once was. But we've also had, we've sort of on this cusp of how high is high, right? We keep hearing from the Fed that, well, we might be there, we might not be there. And we've had a number of, mixed messages. But there's a lot of narratives, as you say, a lot of stories going around that it was supply, which I think is not probably a good explanation, because we always have supply and we always know when that supply is coming, and I don't think anybody woke up yesterday and said, oh, we have a rising deficit, right? We had some stronger than expected economic data, that blowout jobs report in terms of the numbers, but with low wage growth, so sort of offsetting it. And I think that you have this, you're talking about uncertainty, that drives up the term premium. It's highly correlated with volatility. And so there was just a lot of questions, a lot of stories going around, and a lot of people trying to get an explanation.
There are 2 ways to interpret this. On one hand, you have an interpretation that the volatility might mean that something could break and that it makes things more vulnerable. Or you could say the volatility has been incredible and nothing has broken, which highlights just how resilient the market is. Which take do you take?
I guess I would be more concerned that there's still some things that could break, not looking for a big explosion or something. But you can't have this high a level of real rates, this rapid an increase in rates, this tightening in financial conditions under the surface, not just, if you look at the spread data, maybe it's not so much. But when you look under the surface at what's happening with tightened lending standards, with what's happening with bankruptcies at smaller firms, you're starting to see some cracks. And I think that's also what's being reflected in the Fed speak. One of the things I do when the Fed's reports come out, their regional indices, is read the comments. It's a treasure trove of anecdotal data. And I think that they're probably reflecting a lot of the comments coming out from the businesses in their districts saying, hey guys, enough. Commercial real estate's a problem. Financing's a problem. Car sales are a problem. We're running into those sorts of things. And I'm guessing that some of the shift in the Fed speak is a reflection of what they're hearing on the ground.
If the Fed does hold off on raising rates an additional time because of how much rates have gone up on the long end, is that good or bad for longer-term bonds? I mean, all things being equal, if you believe in the economic data, then wouldn't that mean that longer-term yields should go higher because it allows the momentum to actually pick up all that more?
Well, I think if you believe that the lagged impact is still working, which is what we're hearing from a lot of the various Fed speakers right now, Bostic and Lori Logan, et cetera, saying, we haven't felt the full impact of this, then you don't need to have the long end rally that much. Or, I'm sorry, rates move up at the long end that much to continue this constraint. But the question is, have we hit peak? And if we have, does the yield curve then disinflate because we anticipate lower rates going forward rather than higher rates going forward?
What's the signal of weak growth here? The bear steepener or the bull flattener? Because traditionally, I used to be told it was the bull flattener. That was the market pricing out growth.
Right.
And now we're welcoming the bull flattener in bonds and we're scared of the bear steepener. Does that make sense to you?
No. I would say you want, when it disinverts, you want it to be because rates are coming down at the short end, not because rates are going up at the long end. They do tend to converge at the peak. You do get this flattening out at the peak, but it's usually with short rates coming down. So it doesn't make a lot of sense to me that if you're going to make a weak economic growth call that the steepening is consistent with that.
So I'm with you on the anecdotes. We spoke to Patrick Harker at the Philadelphia Fed in Jackson Hole. I remember precisely what he said. He's been hearing from people in his region, in his district, that are basically saying they've gone far enough. Hear those complaints all the time. So with that in mind, when we get the Fed minutes a little bit later, how does someone like you read those Fed minutes? Are they dated? Do they mean anything?
I do read them just because any small changes in the wording will be significant. And I try to find out, is it several, is it a few, is it a lot? All those key numbers of how many people at the Fed feel this way or that way. But it is somewhat dated at this stage of the game, too. It's not, it's already, once you're 3 days out from the Fed, it's over.
The Fed speak from a couple of days ago is dated based on the moves we've seen in just 2 trading sessions. In fact, it's not even 2, is it? It's like 1 in a few hours.
1 in a few hours. 1 in an overnight session that tends to be volatile.
Just absolutely ridiculous. Kathy, thank you. Kathy Jones of Charles Schwab. Just the latest here from UBS. Just want to give you a banking update on how some of these institutions as businesses are responding to the tension in the Middle East. UBS has imposed a work-related travel ban on its staff within the Middle East. They've also postponed a wealth management event that was due to take place in Qatar this month. So, Lisa, just to repeat that, UBS imposing a work-related travel ban on its staff within the Middle East.
You can imagine that there are probably adjustments happening across the board because you have to think Israeli staff are being called up to the army in mass numbers, the working age men and women. You have to think about a whole host of different ways that different companies are trying to rearrange some of their plans.
We'll see how other financial institutions and businesses respond to the developments over the weekend and through the next week, months. And who knows how much longer for. If you are just joining us, welcome to the programme. On the S&P 500, we are positive here by 0.3%. Yields are lower, a whole lot lower, by 8 or 9 basis points. The 10-year, 4.5644. Let's go through those numbers again. What we saw on Friday and what we see on the screen right now. On Friday, high of the session, high of the cycle, 488.52. We're back down to the 450s. That's the 10-year. On the 30-year, through 5%, we've done that a few times, 5.05%, the cycle high, session high on Friday's session, and we're all the way back down, Lisa, to 473.31.
Kathy Jones said something really profound, which is that this is volatility in term premium, which happens when you get this sort of uncertainty, and this tends to happen. And all of these moves really have been driven not by inflation expectations, but by term premia. And so it raises this question of, well, if we get this kind of volatility, if we're in a prolonged period of uncertainty, couldn't we get higher yields throughout that period, whether or not you have an economic justification for them?
I've been looking forward to this conversation, Lisa. Dilip Singh of PGIM, because he's been talking about that, the loss of predictable demand in the bond market. That's something we need to discuss as well. Are we talking about a change of the buyers? Not demand strike, just a change of the nature of where the buying comes from.
That's what people think, just because you have Japanese investors who can go back home and actually get some yield. The idea is not just, are there enough buyers? It's, are there enough price-insensitive buyers? That is the distinction that I think really needs to be drawn.
That's the major change in the last couple of years. QT, China pulling back to some extent. That's a conversation we'll have next. Dilip Singh of PGIM Fixed Income just around the corner from New York City. Equities higher from New York this morning. Good morning.
if it turns into a wider conflict, say, and that causes oil prices to go up, that does have an effect on the economies. When you look at the numbers, suppose oil prices, say, went up by around 10%, then about 12 months later, you see inflation going up by around 0.4 percentage points. Global output is lower by about 0.15 percentage points. So it can have these kinds of effects, but again, it's too early to tell exactly what's going to happen.
That was Gita Gopinath, the IMF First Deputy Managing Director, speaking with Bloomberg's Francine Lacqua at the economic impact of the Israel-Hamas war. Francine Lacqua at the spring, or rather annual, World Bank IMF meetings in Morocco. TK is going to be over there. I understand in a few hours' time he's going to get to that conference and, Tom gets settled.
Yeah.
We'll do a nice conference, do a couple of panels and fly back and maybe have a vacation along the way.
Hopefully we can get some pictures. I would like to see where he peruses and whether he really starts to absorb the culture.
Agreed. TK, we'll get a phone interview with Tom over the next couple of days. don't know if you do. Dilip Singh of Pigeon Fixed Income weighing in on the Israel-Hamas war, writing this: national security experts debating whether the US has sufficient throughput capacity to back Ukraine, Israel and possibly Taiwan in a simultaneous and extended conflict scenario. The unanimous and emphatic answer from experts is no, which underscores the likelihood of a period of fiscal dominance in which deficits are mostly disregarded and interest rates must adjust to a higher equilibrium. Dilip Singh, the chief global economist and Pigeon Fixed Income, joins us right now. Dilip, wonderful to catch up with you, sir. What a difficult time. I'm going to lean a little bit on your experience in the administration along the way in this conversation as well. Paul Tudor-Jones caught up with a regional business news network called CNBC in the last 24 hours. You might have heard of Paul. I'm not sure about the network. Dilip, this is what he had to say. He said he's never seen this kind of geopolitical tension in the last something like 50 years with the deficit position, the budget position of the United States this week. Dilip, how important is that?
He's right. The backdrop is we've returned to the most intense period of great power competition in at least 3 decades. That's going to mean more demand on fiscal spending to shore up our sources of competitive advantage. And it's also the reality that we're seeing a surge of yields driven by term premium because bond investors, they don't know whether we're going to grow fast enough, whether tax revenues will be high enough to service a rising cost of capital. They don't know whether other buyers are going to show up at auction. And they don't know whether Washington, D.C. can exert enough fiscal restraint if growth falters. And that's why you're seeing this repricing. It's a very challenging time.
Dilip, you wrote this column that we found fascinating and we've cited quite a bit about the lack of price-insensitive buyers really questioning the ability for the U.S. to borrow at some of the rates that they were accustomed to in the past. Can you just bring that forward to today's moment with increasing calls for military aid? How much does that actually make you double down on this idea of borrowing regardless of where rates are in order to finance national security and other concerns?
Well, Lisa, here's how I synthesize what's going on. There are 3 fundamental dynamics. What's the Fed's near-term reaction function? What's long-run neutral? And what's the term premium? And then you have to overlay the impact of the attack on Israel. On the Fed's reaction function, I think Lori Logan said it best. And we have a higher term premium. A higher term premium, all things equal, implies a softer economic outlook and greater likelihood that the policy rate has peaked. Okay, on long-run neutral rates, I think what we're seeing, with payrolls and lots of other evidence is that something really positive is happening on the supply side of the economy. That's how you can get above trend growth alongside disinflation. So long run neutral rates are going higher. Then you have term premium. We just spoke about that. The balance of risks are still moving higher. If the house is in disarray, that means no durable fiscal consolidation is on the horizon. And therefore, you have a durable risk of a supply-demand imbalance. The Fed is no longer showing up at every Treasury auction. Neither are large overseas buyers to the same degree, either because their savings balances have fallen or because they want to diversify their holdings. And now overlay the impulse of the attack on Israel. It's another injection of uncertainty. It's another potential supply-side shock on energy prices. And the net of it for me is you do get a higher drift in long-term yields with an anchored front end.
So based on what you're saying, Dilip, do you think that the move that we've seen, barring the past couple of days, in longer term yields makes sense, or that it's not high enough, or that it's gone a little bit overboard?
Well, Anne-Marie said it right. Right now we're in the thickest fog of a hideous and tragic war. And so we're seeing a flight to quality on the back end of the curve. But I think over time, as market participants think through the second and third order effects, the forces that I mentioned are going to cause a drift higher. And the front end, I think, that's where I have the most conviction at this point. I think the Fed has said now with a chorus of officials, we're going to let markets do the work for us. And if the data continue to moderate, both on growth and inflation, we can watch and wait.
Dileep, I just want to finish on the potential policy response. And this, I think, involves your experience in the administration. What kind of sanctions response should we be looking out for as a team, for the investors listening to this program right now? What would you expect to see from the administration, the White House, in the coming weeks and months?
Well, I mean, the leading edge of any response from the administration, if it proves necessary, will be in the military realm. That's why you see 2 aircraft carriers moving to the Eastern Med. That's why you see all of these efforts to shore up Israel's Iron Dome. There will be a sanctions component because money is fungible. To the extent that Iran is seen as directly involved in the planning and execution of the attack, I think you'd see the screws of sanctions tighten. That would be a global effort. But that's second order to the military response.
Dileep, much has been said about the sanctions response and the fact that perhaps this administration turned a blind eye to Iranian crude production and perhaps Chinese buying off that crude. What's your view on that?
I disagree with the premise. I mean, I know there's a lot of hype about the $6 billion. The administration's spoken pretty clearly. Not a dollar has been sent to Tehran. I would be shocked if a dollar ever moves to Tehran in the aftermath of this attack. And so, there is going to be, I think, less and less Iranian crude oil on the market. The question for the administration is, can they get an offset from Saudi, from other sources, from domestic producers? That's going to be the challenge.
So, Dileep, you just said that you think that refreezing that $6 billion is pretty much a certainty at this point. Is there a potential ramification? Does this have any kind of play into some of the accusations of using a dollar as a weapon or any of these talks that have really flared up a couple of years ago?
I don't think so, Lisa. I mean, if we're talking about the barbaric invasion of Ukraine or this hideous attack on Israel, there have to be consequences. And when you stop short of deploying your military, economic tools are the second best resort. So that's what we're seeing. I don't think it's a threat to dollarization. We're going to move with our allies, and we're doing so to uphold the principles that underpin peace and security across the world. That's good for the world. That's good for financial markets. That's good for the economy. That's what these sanctions do.
Dileep, don't be a stranger. It's great to catch up with you, sir. Hopefully we can do that again soon. Dileep Singh there of PGIM Fixed Income. On that $6 billion that's been talked about so much over the last couple of days, I'll go back to what Secretary Blinken said, that it is very carefully and closely regulated by the Treasury Department to make sure that it's only used for food, for medicine, for medical equipment. You have to imagine at this point, never mind refreezing it, are they ever going to allow a single dollar to leave that account?
Dileep Singh there saying he can't imagine that they will, right? Because if you imagine, even if it's going to aid, it's dollars that Iran doesn't have to spend out of their own money for that same type of aid. This
Precisely.
is the argument that people have been making. Regardless, John Kirby said yesterday that no determination has been made yet. They are looking at that. But given how much pressure there is on this administration and just generally, regardless of what they find in the details of Iran's involvement in the attack, it seems like there is enough, as Dileep was saying, that they are going to refreeze that $6 billion.
A couple of updates this morning. This from UBS, just the business response. Logistically speaking, day-to-day business for banks like UBS and what this means after the weekend's events. UBS imposing a work-related travel ban on staff within the Middle East and postponing a wealth management event that was due to take place in Qatar. I find that interesting, Elisa. Not just Israel. This is across the Middle East, including a place like Qatar.
But this raises the question, right? At what point does this escalate in the unpredictability of a potential escalation? Why would a company put people in the potential of harm's way? Also, you have to imagine there are people who are canceling. You've got to imagine that there's some people who don't really want to be traveling in a region where there is a feeling of instability. We've already seen a whole host of airlines cancel flights to Israel in particular. But again, if you're in that region, there's probably some hesitance.
We'll see if we get more of that in the coming days. Just to get you set up for the next hour, this is what it looks like. So at 8:30 Eastern Time, about 34 minutes away, PPI data in the United States of America. 24 hours after that, you'll get CPI data in America. They're the two big data points going into Friday when we get bank earnings. At the moment, equities higher by 0.3% on the S&P. 3 days of gains could become 4. Yields a whole lot lower. We're down 9 basis points on a 10-year.
The market takes out the human factor and the horror and looks at this in a much plainer, cold-hearted light.
There's just so much bifurcation underneath the market.
The Fed is not going to adjust policy based on a temporary move in headline prices.
Guys, it's a generationally levered system. Higher for longer isn't good.
At this point, solid would be, we don't go into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I say this all the time, we shouldn't have favorites, but Tony Dwyer
100%
is in the mix. He is a favorite from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.3%. It is a 3-day winning streak on the S&P, the longest going back to late August. We could make it day 4. It's held out by this big move in the bond market yesterday, 2-year, all the way out to 30-year bonds. Yields lower by double digits this morning. We're lower by 8 to 457 on a 10-year. This hour, inflation data out of the factory gate. PPI data at 8:30 Eastern Time. On to tomorrow, Bramo, consumer price data.
Which may give a little bit more of a compass, as we've been hearing from people, that could underpin some of these moves with a little bit more fundamentals. How interesting that typically we've always said that stocks were the more volatile asset class and that bonds sort of got carried along for the ride. I would argue the tail's wagging the dog in every which way it has been. And I could say that what we've seen over the past few days, even more so, even on days when bonds weren't open, then stocks were less volatile. Bonds get open in terms of the market.
The bonds the dog or the tail?
I think that bonds are... That's a good question.
Just trying to figure it out, Bramo. Let's make sense of this.
Okay, that's true. Okay, I think that probably the bonds are the dog, because I think they're probably the main thing. Right. They're the ones that look at the balance sheet rather than the stories.
TK's not here. Someone's got to screw up this program, right?
so it's going to be you.
Disrupt things.
Well, there you go. You did a great job.
30-year down by about, down by about 9 or 10 basis points on a 30-year. It's quite phenomenal. You talked about it. You referenced it. I know, and I'm with you. Yesterday, we saw double-digit gains. Treasury yields lower, or rather double-digit losses on the yield. Last week, the opposite, the total opposite. How much has changed in between? If anything, we had really strong data on Friday in the payrolls report.
But what we just heard, and this I think that Kathy Jones said, is it is a lack of liquidity. It is also a lack of certainty on such a profound level. And in times like this, she was saying, typically that increases the term premium. When do we get more certainty? Are we going to get it with PPI out of the factory gate, as you mentioned, in about a half an hour time? Are we going to get it with CPI? Are we going to get it with JP Morgan earnings and all of those that come subsequently? The picture is muddied. It is a difficult moment to really capture. And this is typically what happens at tipping points in the economic cycle. So if you do get this kind of whipsaw action in bonds, does that lead to a consequence independent of some of this other economic data?
Let's talk about some company news. You mentioned the banks on Friday. JP Morgan results just around the corner. LVMH delivered yesterday. The post-pandemic luxury boom is over. They've basically called that. We can talk about that all morning. Let's take a look at Exxon and Pioneer in the pre-market. Exxon delivering what could be its biggest deal since the 1990s, 1999, with Mobil. Now looking at Pioneer at 1.9% in the pre-market to about 242. They're going to pay $253 per share, all stock deal, according to the statement we saw this morning. Lisa, $60 billion agreement.
It would be the largest corporate takeover deal announced so far this year globally, just to give you a sense of the scope and scale of what we're looking at. And it comes in one of the hottest areas for investors after so many years of people shunning the oil complex. At this moment, it is interesting that this is where we're seeing massive deals. And the biggest questions are not why is this happening now, but who is next at a time when people would like to see more consolidation.
Just a programming note, in about 1 hour and 35 minutes, Alex Steele catching up with both Darren Woods and Scott Sheffield. Woods of Exxon, Sheffield of Pioneer, a conversation you do not want to miss a little bit later. Let's turn to the price action. Your equity market on the S&P 500 shaping up as follows. Positive here by 0.3%. A lift in this equity market, even with Friday's blowout jobs report. Equities gained on Friday. They gained on Monday. They gained on Tuesday. Let's see if they can gain this Wednesday. And the bond market yields lower by 8 basis points at 457. Our top story this morning, Israel, Hamas, the war continues. Anne-Marie Jourdain, our Bloomberg chief Washington correspondent, joined us from the nation's capital. AMH, what are you looking out for today?
Well, today, Jonathan, we have an update on the president's schedule. So this does seem that the White House wants to make sure that the president is outspoken in the days ahead when it comes to the atrocities that happened over the weekend. And now as we see a war reciprocate on the Israeli side. So the president will be stopping at a roundtable with Jewish community leaders, and he'll be delivering remarks there. We should also note the president yesterday alluded to anti-Semitism. He talked about how this attack brought to the surface painful memories and scars left by a millennia of anti-Semitism and genocide of the Jewish people. So I think you're going to continue to see this outreach to the Jewish community here in the United States from this president. He's going to want to continue to talk about what he called yesterday the unwavering and ironclad support from the United States to Israel.
Anne-Marie, how much are the president's hands tied based on the lack of a speaker in the House?
Well, the president is able to use other methods to make sure that Israel is getting some support and protection immediately. There's reporting that the first tranche of ammunition is already arriving in Israel today. You know, the most important thing is going to be to replenish the Iron Dome, those interceptors that the Iron Dome needs in the anti-missile system to be able to function. And also, they quickly and swiftly moved the USS Gerald R. Ford to the eastern part of the Mediterranean. And we heard from the Joint Chiefs of Staff come out and say that that was to deter Iran. And we should make no mistake how big of a force that is and a statement that is for the wider region. So that's already what the president has done. Yesterday, of course, he did come out and he said when Congress is back in session, he is going to make sure that the national security concerns of our partners are addressed, and he's going to push Congress to act. So with the term partners, that's linking Ukraine aid with Israeli aid. And yeah, obviously, it's very difficult when the House of Representatives is speakerless. They're at an impasse right now. But Patrick McHenry did allude that if the government needed to get something done, they would be able to do it.
Just quickly, Anne-Marie, how united is the Democratic Party behind President Biden's view?
For the most part, the Democratic Party at this moment is very united. You are seeing broad bipartisan support when it comes to aid for Israel. There have been fractures, of course, in the past regarding support for Israel, especially amongst members of the far-left progressive wing of the party. I'm thinking of individuals part of the squad. Many have come out and condemned what had happened over the weekend, but many also noted about some of the really devastating living conditions that Palestinians have had over the course of years and decades, and also poking holes at the current far right-wing tenure of the Israeli government.
AMH, thank you. The latest down in Washington, Anne-Marie Jourdain. Let's continue this conversation with Nimrod Goren, the Senior Fellow for Israeli Affairs at the Middle East Institute, a non-profit institute that seeks to increase knowledge of the Middle East among citizens of the United States. Nimrod, thank you for joining us today. I want to pick up on a story that you've been discussing with us already. The relationship between Israel and Saudi Arabia. It looked like we were getting closer and closer to some kind of pact. There was a sense on Monday that the massacre that took place over the weekend would set us back. Do you share that?
It sets us back on the short term, but the process that we've seen over the last weeks and months, in which there is a gradual upstepping of the Saudis of their engagement towards Israel, their openness to host Israelis, first as business people, then as athletes, then as formal delegation with ministers in Saudi Arabia. There is an interest in the Saudis' sphere to engage with Israel, to go towards normalizations. There were discussions about the conditions. What happens now in Gaza will probably slow down the process, but once the dust settles, the interest is still there, and I guess the process will continue. It may take more time, though, than initially planned.
Nimrod, you've studied the peace processes that have been attempted in the Middle East for so many years. A lot of people are saying this feels different and more intractable than what we have experienced in the past. Can you put it into perspective in terms of how you see it potentially evolving based on the signaling that we've heard from people in the region?
What we say happening now in Gaza and in Israel is detached from the peace process, because the peace process was conducted with the Palestinian Authority, the leadership, the PLO, which has recognized Israel in the Oslo Accords, which is ready for a two-state solution. Hamas leadership is somewhere else. It has a position that does not recognize Israel. It is not supportive of the two-state solution. As we see in current events, it engages in terror and in wishes to inflict as much damage on Jews and Israelis as possible. So this is not a partner of Israel for peace negotiations. I think the goal of such a process that we are seeing now on the ground will be to eventually have the Palestinian Authority, which is the more moderate faction within the Palestinian society, also rule the Gaza Strip, as was initially happening. And then you will have a leadership that has the capacity to negotiate, to try and advance a peace process. Of course, once we have in Israel a leadership that supports the two-state solution, currently we do not have that in Jerusalem as well.
Well, that's where I was going to go. There are a lot of questions about what the Israeli government knew before the attack took place, intelligence from Egypt in particular. What do you think the legacy of Netanyahu is going to be, and what do you think the trajectory of this will be at a time where people are coalescing around an emergency government now, but this has been a point of significant contention?
If there is an emergency government, it needs to focus on managing the war and not beyond. Netanyahu has failed. He's failed on our democratic identity over the last year. Now he's failing on our security. I think after this war is over, those in government should pay the price for their failure. And Israel is in need for a fresh leadership. It may take time. We know the tendency of the Israeli electorate are tilting towards the right in the previous elections. But we did see a government in the previous term of Yair Lapid and Naftali Bennett, two different ideological stances coming together for the national good. I think that's what Israelis want at the moment, something that is focused on national interest, on good governance, on moderation. And after the heavy price paid now, eventually when the discussion will turn back to politics from security, there will be a growing demand for change.
Nimrod, just to leave it there, do you believe that the division domestically led to those security failures?
It shouldn't have led to the intelligence failure. That's something totally different. But it did lead to a government putting its priorities in not the right positions or not the right places in terms of where forces were allocated, in terms of where the resources were invested over the last year. So this is not the reason. What happened on Saturday shouldn't have happened anyway, with or without the divisions. There was something happening wrong, and that should be figured out and fixed. But definitely the context, the overall context of division, polarization, misconduct, didn't bring Israeli society to confront this challenge in the best possible terms it could.
Nimrod, thank you, sir, for your perspective. Nimrod Goren of the Middle East Institute. If you are just joining us, welcome to the programme. Here's your S&P 500. We are positive here by 0.3%. Just to get you set up for the next 20 minutes or so, economic data in about 20 minutes' time, 8:30 Eastern time. We will get PPI data 24 hours before we hear from CPI. CPI data just around the corner as well. This is what we heard from Savita Subramaniam in the last couple of weeks. Equities can still work in a higher rate environment was a note that the team at Bank of America put out in the last week or so. Savita's going to join us next, Lisa.
Sebastian Page earlier just saying the same thing, and this is something people are coming to terms with. If those higher yields come, and this goes to a point you made earlier, John, if they're coming in tandem with strong economic growth, that can overwhelm the hit to borrowing costs. But that if is a big one, especially given some of the conversations we've been having, in particular with Talib Singh.
What did Tony Dwyer say over at Canaccord?
Yeah.
Got a load of leverage in this system. Higher rates aren't good.
I know, and this is sort of the reason why people are flummoxed over why we haven't seen more of a reaction in the real economy to rates where they are. Deutsche Bank, George Saravelos came out this morning with a note that said that in the U.S., the reaction function that the Fed policy has been incredibly dampened in a way that has been completely unpredictable.
I'm going to use Kashkari's word, perplexed.
Keep using it.
Perplexed.
We're all perplexed all the time.
Savita Subramaniam with Bank of America coming up on this programme in about 5 minutes' time. Later on, after that PPI report, the PPI data, we'll hear from Torsten Slok of Apollo. All of that coming up over the next 30 minutes or so. Your equity market on the S&P 500 looks like this. Equities up by 0.3% on the S&P. Yields are lower. That move fades just a touch. We're down 7 basis points from New York. Good morning.
If the markets, in the case recently, bond yields have tightened, meaning financial conditions have tightened, that's an indicator financial conditions broadly have tightened, it's more expensive to get a loan, then Well, if that's tight, maybe the Fed doesn't need to do as much. That's why I said, depending on whether it unravels or whether the momentum in the economy changes, that could be equivalent to another rate hike.
I do love Fed speak. It's like, just imagine, I'm not saying that means we're not going to hike anymore, but maybe it means we're not going to hike anymore.
Different parameters that we can potentially look at that might potentially form our views because we don't know what's going to happen.
I'm perplexed, but ultimately high yields might mean fewer rate hikes. And,
Are you trying
if CPI comes in strong on Thursday, I never said we wouldn't hike anymore. I just said that, if yields are up, theoretically, we wouldn't have to do so much.
Are you looking for a job? Which one?
I don't think anyone wants me at regional Fed.
Not regional, maybe Fed governor.
They don't pay you enough at the Board of Governors at the Federal Reserve, do they?
Is that what you're saying?
No, not at all.
All right.
Mary Daly, they pay you enough on the West Coast. San Francisco Fed money's good money.
All right.
Have you seen that?
So I think maybe you've got to move.
Mary Daly makes good money on the West Coast. I always find that odd that the regional Fed presidents can earn like a multiple of what the governors earn on the FOMC. It's bizarre.
I think a lot of the debate, though, you want to attract the best and the brightest. So either you do it with pay that is going to be higher, or you do it with jobs on the other end that give people the idea that maybe they're being compromised. Either way, it's a lose-lose when you have a situation where public pay is often the flash pin of a lot of animosity.
Well, they can go and do speeches. I don't feel sorry for them. And they sell those speeches for like $800,000 a pop.
But I'm just saying then people criticize the speeches, but it's partly because they're not paid that much at the outset.
When I used to cover the ECB a long time ago, once compared and contrasted the regional governors. So let's take Italy, the national governors. Italy, the Bank of Italy governor would earn more than the ECB president. So Draghi technically took a pay cut. And if you look at the S&B, Swiss National Bank.
That's where it's at?
Oh, that's where it's at. I think it was something like 800,000 Swiss,
no.
something like that. Yeah,
Seriously?
Check it out.
Thank you.
Google
Are you trying to get me to go apply
No, I don't think I want to go to Switzerland. Well, that's good fun. Savita Subramanian, head of US Equity and Quantitative Strategy, has a job at Bank of America. He joins us now. Savita, good to see you.
Nice to see you.
Good to see you. Constructive, and I read your note from the other week that this can work. We can see equity returns in a higher rate environment. So do lower rates hurt us or help us as well? Which one is it?
So I think that lower rates I think there's too much focus on the short end of the curve. I think the long end of the curve probably matters more for stocks. And then when I think about, why the long end is moving higher, one of the reasons is supply, demand. There's less demand from the Fed and China, BOJ, et cetera. But there's also this growth story that you could argue for, which is the idea that companies are now focused on, what they should be focused on. So we're in an environment where I think a lot of the levers for margin improvement from kind of lower quality sources like globalization or cheap financing are behind us. But ahead of us is this very exciting new theme, which we haven't talked about for a long time, which is efficiency, productivity, replacing labor with, more efficient procedures, be it AI or automation, et cetera. So I think that those are the drivers that could move the market higher from here. Now, what's interesting is that so far this whole AI theme has only been rewarding tech. And I think that the story is so much broader than that. So, based on our quant work, we've found that if the S&P 500 has the opportunity to become even labor lighter than it is today, that translates into stable margins and a bump up in the multiple, because investors are willing to pay more for efficiency gains than just low quality, Fed money plus a little bit of globalization.
Are you saying that the AI boom has maybe been priced in accurately for tech companies, but inaccurately priced for the rest of the complex that will benefit in just a significant way?
That is a much more eloquent way of saying what I just said with many less words. But I do think that that's the idea is we're in this environment where it's like old economy is terrible. Don't buy anything that's not tech. We're going to get money from this AI theme. I think the idea here is that old economy companies that are labor intensive have more tools to get labor light. And what we found in our quantitative work is that companies that become labor light always outperform companies that don't. And it's kind of an obvious point, but it plays out in the data.
Part of being able to get there and to survive long enough to get there is to be able to make investments, which requires money that potentially you have to borrow. So it raises a fundamental question about at what point the rate structure makes this prohibitive for some of these old economy companies to come up to the new world. What's the tipping point for yields where it starts to matter really significantly to you?
For the S&P 500, I think we can see higher yields. And I guess the good news is a lot of these problematic companies with floating rate risk and that are unable to handle current rates or higher rates have dropped out of the S&P 500. So there's been this sort of natural attrition out of the S&P into the Russell 2000. What I think is really interesting is that twice as many companies have fallen from the S&P to the Russell than have risen from the Russell to the S&P compared to an average year. So that is telling us that it's basically a story of the losers dropping out of the index into other indices. I don't love the Russell 2000 right now. I think it's riddled with, small cap zombie companies like healthcare tech, companies that can't handle this rates environment. But I think the S&P 500 has seen a lot of those problem stories drop out, and it looks pretty healthy today.
You like the equal weight, right?
I love the equal weighted S&P 500.
Why is that?
Well, I just think that as you pointed out, probably a lot of this good news has been priced into the mega cap tech cohort, maybe even overpriced into the mega cap tech cohort. Everybody owns these companies, so there's not a lot of buying pressure if you think about who's next to load up on the Magnificent Seven. But there is a broader array of companies that actually look pretty healthy. And if we don't go into this, hotly forecast recession that we're all preparing for and bracing ourselves for, I think that the market could rip from here. The equal weighted S&P could rip.
It could rip. What kind of upside is rip?
So, yeah, it's all relative, right? I think that what we're forecasting through year end is 4,600 for the S&P. I think the equal weighted S&P could do double those gains. So from here, it's not that demonstrable. Wow. But I think over the next 10 years, buying the equal weighted S&P 500 today on a valuation basis suggests that you could get more than 10% price returns per year from the equal weighted S&P. This is not an environment where a lot of other asset classes promise 10% returns plus additional dividend yields.
What I'm doing technically, though, is stripping out the muscle of big tech.
Yeah.
And relatively speaking, giving, say, financials a bigger presence. Do I want to do that right now?
So financials is a tricky one. I like financials. I like large cap financials because A, the banks have already been regulated. B, a lot of the bad news is behind us. C, there's got to be a shape of the yield curve that helps the banks. And what's interesting is that every phase of the yield curve has been cast as bad for banks. I think we're actually moving into an environment where, if the Fed is closer to being done on the short end and the long end is potentially higher for longer, that's historically been a good environment for lending. I think the banks also have the opportunity, and old financial companies have the opportunity to get less labor intensive, which is bad for me, but it's good for margins of financial companies. So lots of levers that I think are underappreciated, as well as the fact that if regulated banks are regulated utilities now, why don't they have the multiple of a regulated utilities company?
Is your view predicated on the idea that we're really not going to get much of a recession? Is this basically predicated on the Fed's view of the world?
This is predicated on the idea that the reason it's taking longer for the Fed to control this economy is that a lot of that leverage risk has been taken out of consumers and corporates and moved to the public sector, the government balance sheet, and the Fed's own asset base. And while that all sounds nerve-wracking and terrifying, that we're sitting on levels of debt to GDP that are similar to emerging economies, what we found is that high levels of government leverage are not anathema for stocks. So this is interesting because I've always been kind of worried in the background about this looming debt to GDP for the U.S. and what's it going to do to us. It seems really awful. Leverage is evil. The truth is the market actually outperforms or does better during periods of a higher leverage ratio in the public sector than lower. So leverage in the public sector isn't necessarily what we need to worry about. Maybe it makes our bonds that much less attractive, which I think U.S. Treasuries might be the riskiest asset class.
We can have this conversation for a long time. I wonder if that's associated with coming out of bottoms in the economy, and that's when the deficit is widest.
And we grow our way out. Exactly.
Sure. Just got a headline from Norwegian Cruise cancelling calls to Israel for the rest of 2023. UBS earlier banning work travel for the Middle East staff. Just the latest there. Savita, thank you. It's good to see you, as always. Savita Subramanian there of Bank of America. Live from New York, PPI up next.
Here comes the data just moments away from PPI factory gate data that comes out heading off what we can see as a 1-2 bonanza. Today, PPI, tomorrow, CPI to get a read on inflation. Heading into that, we are seeing a bit of strength in the equity market, driven by a bit of strength in the bond market. Yields lower for a second straight day, although coming off some of the earlier lows, down as much as 10 basis points earlier this morning. But the two-day decline is almost 0.25%. Right now, we are getting that data. Let's head over to Bloomberg's Michael McKee. Mike.
Well, all the Fed people who've been optimistic may be a little bit disappointed by the numbers that we get today. A 0.5% increase in PPI for final demand on a month-over-month basis. It's down from 0.7 in August. However, that is almost double what was anticipated. The core rate comes in up 0.3, which is 0.1 more than it was the prior month. And the super core for PPI, ex-food, energy, and trade services, is up 0.2. That's a slight improvement. For final demand on the year-over-year basis, we're up 2.2%. Which is unfortunate. We were 1.6% in August, so going the wrong way and back over 2%. Ex-food and energy, 2.7%. That's up 0.5 percentage point from the August number. And the ex-food, energy, and trade number comes in 2.8%. That is down from 0.3. So where we're seeing some improvement is in the retail and wholesale sales side, the trade figures, but the rest of the PPIs rather come in a little hot.
Right now, just taking a look at the market response. It's not massive, not a lot of drama, but you are seeing a bit of a give back to some of the gains in the bond market, yields rising just a touch, as you would expect, hotter than expected PPI data. You're seeing in the stock market, again, a little bit of the reversal of some of those gains, but not a lot of action, which actually is exactly where I want to go with you, Mike. Are you surprised that there's not that big of a reaction, or is this pretty much typical because it wasn't that big of an upside surprise and because PPI isn't as significant as CPI?
I think that last line there, Lisa, that you just said is the most important thing in terms of the market, because the PPI doesn't necessarily lead the CPI in the way people might think, and the CPI is what everybody's been focused on. The interesting thing in this number is that we saw goods prices up 0.9, while services prices were only up 0.3. That's the second month in a row we've seen a big increase in goods prices. I don't know exactly what's pushing that up, but it is the opposite of the trend we had been seeing over the past 6 months or so. I think tomorrow everybody's going to be focused on the CPI, and if we get a different kind of result there, then markets might react a little bit more strongly.
There's also a question about how much companies can pass along some of these costs to consumers, and for a while with the disinflation, that was leading to bigger margins because companies were still passing along price increases to people, and they were absorbing them. Do we have a sense of whether these price increases that we're actually seeing actually reaccelerate, that is going to lead to higher prices in the CPI, or that companies are just going to absorb it, and that means margins coming down?
Well, we don't know exactly, but you can separate out the trade services component of PPI, which is basically retail and wholesale margins. The government doesn't have a good way of measuring prices in those areas, so they look at the difference in margins for companies, and that goes into this PPI calculation. So that area did show a decline, so maybe companies aren't being able to pass on price increases quite as easily. Anecdotally, that's what you hear. That's what the Beige Book says. That's what Fed officials say CEOs are telling them. We're getting a little bit of evidence in this PPI here, but it'll be the CPI and then PCE at the end of the month that'll be determinative for the Fed.
Michael McKee of Bloomberg, stay close, please. I imagine you'll be looking through the data more closely and some of the details. And we'll catch up with you in just a few minutes. Just if you're just tuning in, we did get that economic data coming in hotter than expected. Ex-food and energy, you saw a 0.3% pop versus the expectation for 0.2%. Final demand, 0.5% versus 0.3%. Bonds just retracing a little bit of their gains. You could see yields down now just 6 basis points, down as much as 10 basis points earlier in the morning, 458.91. And you can see S&P futures now up by just 0.2%. Someone who's been tracking the sort of push-pull between inflation and potential weakness around the edges is Torsten Slok, chief economist at Apollo Global Management, who puts out charts that we cite pretty much every single day. And Torsten, I just want to thank you and your team because we always use them as talking points and hot topics. So we appreciate that. But I want to start with your impression of a reacceleration that we're starting to see on the margins in goods prices.
I think what's most important really here is it shows how difficult it is to get the horse back in the barn when it comes to inflation. You think about first, goods inflation went up when we were sitting at home ordering stuff online during the pandemic. Then goods inflation came down when the supply chains came back on steam. And now, as Mike was just pointing out, it looks like goods inflation is beginning to reaccelerate because manufacturing is beginning to show more signs of life. And you have, broadly speaking, therefore, a separate cycle in goods inflation relative to the cycle in services inflation, where initially, when we were sitting at home, there was no service inflation. Now we're all going to restaurants, hotels, basically flying consumer services, and that's why service inflation has been very high. So that cycle difference has been a very important feature, and it shows in the data also today.
What we did see, though, during the immediate aftermath of the pandemic was that people weren't as sensitive to price increases because they accepted that inflation was happening and they had huge bundles of savings that were left over from the pandemic. Is now different? Are you seeing consumers push back, spend less, not actually spend when they see prices going up that much?
Well, if you look at what was the distribution of consumption on goods and services before the pandemic, we have not normalized back to that level in terms of the shares spent on services relative to the shares spent on goods. We still spend, quote unquote, too much on goods. So that means that services still has some more upside. So you're right, people have been willing to spend more money to go to Taylor Swift tickets, US Open in Queens, all these things that have been so expensive because there have still been savings around. But as we all know, and as we talk about all the time, we of course have this issue that savings are running out, combined with student loan payments coming back. All that does point to still more weakness on the consumer in the coming quarters.
When you put charts out, especially on that savings rate, how much pushback do you get from people? Because everyone is so discerning of the type of data and the way that it's being framed that a story painted with data can be dissected in 5 different ways by 5 different people.
That's right. And I think that's also why it's not only about savings running out. It's also about the very big picture that the Fed is trying still to cool the economy down. We hear that also from Mary Daly here in the segment you just played, where we are seeing already in the data, consumers are seeing higher delinquency rates on credit cards and auto loans. Corporates are seeing default rates go up on high yield and on loans. We're also seeing interest coverage ratios starting to dip, both for investment grade and high yield. And also on the banking side, we're also seeing a slowing in loan growth in the weekly data from the Fed, both for large banks and for small banks. So taking consumers, corporates, and banks combined, the Fed is succeeding. This is exactly what the textbook would have predicted, that we're seeing a slowdown on consumption, on corporates and on banks, and that's why this ultimately will result in more slowing over the coming quarters.
More slowing and recession. More slowing is not the same, right? And there's a question of how much slowing is necessary to truly put the horse back in the barn, as you say, to use your analogy. And this has been one of the conundrums that's been baked into the market. Do you have a sense of whether it requires a greater slowing to get that horse back in the barn than people are currently using as a base case? And when I say people, I mean Fed officials.
I do think that we need more slowing because core PCE today is 3.9, and the target for the Fed is that it should be 2. So we are still running around after the horse out there and trying to get it back into the 2% range, and we are just not there yet. That's what literally every FOMC member is telling us. So with that backdrop, given what's happening to delinquency rates for consumers, given default rates for high yield are going up at the fastest rate in the last 6 months in years. So the result of that is that we are seeing the effects of the Fed tightening. Every single day, there are companies that cannot get financing. There are consumers who cannot buy a new car, and at the moment, who have a hard time buying a new home. So in that sense, tighter policy with the Fed funds rate at 5.5 is way, way above the 2.5% where the Fed in the dot plot thinks we should be in the long run. So policy is working exactly as the textbook would have predicted. It's just the savings making it take a little bit longer time, but we are moving towards, in my view, a faster slowdown, what the market's consensus is expecting.
We're going to put the horse back in the pasture and leave that alone for the remainder of our time. But I do want to know why we are seeing upside surprises to the economic data in such a significant way. If there is this material slowing. I mean, this has been one of the conundrums for so many people who are expecting and seeing anecdotally all of the slowing, and yet each economic print coming in stronger, stronger, stronger.
There are some exceptions to that. I know the labor market obviously is surprised to the upside on the headline, but if you look under the hood, you see that in particular in terms of job openings, peaked literally in March of 2022 when the Fed started raising rates. That's been coming down. You're also seeing the work week coming down. You're also seeing wages for job switchers coming down. You've also seen an increase in percentage of permanent job losses. So a number of the labor market indicators under the hood are showing more signs of weakness, and we are definitely moving towards that we will ultimately get that increase in the unemployment rate that Jay Powell has talked about.
Given the unrest in the Middle East, there's a lot of focus on oil prices and what would happen if oil prices do have a sustained rise. How do you factor that in to your concept of a harder landing than people are certainly accepting?
That is certainly a very important point. I mean, oil prices, now they first went up and now they've gone down a bit, but it's certainly the case that the move in oil prices is very critical also, in particular, of course, for headline inflation. So from that perspective, the second round effects are likely going to be more limited, at least historically they have become more and more limited over time because the economy is less sensitive to oil prices, is less energy intensive. But the short answer to your question is for headline inflation, and therefore also for the Fed, it does become important what oil prices are doing.
When we shake out, where are you? Where is your thinking in terms of the long-term neutral rate and how much it shifted upward, given some of the paradigm shifts?
I think that there are some very important arguments for why the long-run rate is going to be higher. We first of all have more deglobalization, more segmentation globally. That's putting more upward pressure because of onshoring or reshoring and friendshoring, increasing cost of production. We also, generally speaking, have that energy transition is going to be costly. That also is going to put upward pressure on the production of energy, and therefore if people pay more for energy, including the adjustment costs, then that will also be putting upward pressure on inflation. And finally, we likely also have globally less immigration, and if that's the case, that also means that we're likely to going to see higher cost of production, not only in the US, but also in Europe and abroad. So the conclusion is both deglobalization and also energy transition and also what might be happening with immigration all argues for that the long-run rate, neutral rate, is likely going to be high. The Fed says that in the long run will be 2.5, but we could be up closer to 3, maybe even 3.5. And that's very important for anyone planning with a long horizon because that's telling you that on page 1 in the finance textbook, if the risk-free rate is going up, we all in financial markets need to pay attention.
Torsten Slok of Apollo, always wonderful to get your thoughts. Thank you so much for being here with us, Torsten Slok of Apollo. I just want to update you on the figures. We did get PPI final demand coming in 0.5% versus the increase of 0.3% as expected in markets. You can see what you would expect, although muted, because the relevance of PPI to final prices, not necessarily that correlated, but still the 10-year yield lower now just by about 7 basis points versus 10 basis points earlier. S&P futures up by 0.2%. Right now, I do want to head back to Michael McKee, who is in our Bloomberg Washington, D.C. bureau. And what are you finding from the data as you parse through?
Well, this is interesting, Lisa. In the overall PPI for final demand, goods prices, as we mentioned, rose 0.9%. The BLS says 3/4 of that was energy, a 5.5% rise in gasoline. Now, this is at the wholesale level. When you look at this at the retail level, we did not see a major rise in gasoline prices. So the CPI may tell us a different story tomorrow, may not be picking up energy. When you subtract energy and food out of the PPI, you end up with just a 0.1% rise in the goods category. So it really was an energy story there. On the services side, services only rose 0.3%. But a lot of that was, again, banking and deposit services, a 13% increase. And that is something we've seen in the CPI as well, where where banks and brokerages are making more money on commissions, and that is coming in as an increase in inflation. Not something that the Fed is going to particularly worry about.
So just putting this together, Mike, not a lot of correlation for tomorrow, but expectations for tomorrow are for a similar cooling, correct?
That's correct. They are thinking we're going to just see a small increase of 0.3% in the headline again, and that's not going to push up the year-over-year number too much.
Michael McKee, as always, thank you so much. Coming up, Bloomberg's Alex Steele on the Exxon Pioneer deal as we parse through what the potentially biggest deal announced globally means for the shale, the Permian Basin, as well as oil globally. This is Bloomberg.
What we know is that financial market conditions have certainly tightened. That's not even a question. I think the important thing to note there is that allows us a little bit of patience, that we can continue to watch as economic conditions and financial conditions continue to evolve.
That was Mickey Bowman, Federal Reserve Governor Michelle Bowman, speaking at a panel in Marrakesh at the World Economic Forum, at the IMF and World Bank meetings that are taking place there. Our own colleague, of course, Tom Keene, is heading that way, and we will be catching up with him soon. This morning, we've been talking about a whole host of issues, of course, the conflict in Israel, as well as the economic data that just came out in terms of inflation and how much it's coming in, maybe not as fast as people would like. You can see that playing out in the markets, although not really that significant move given the fact that we got an upside surprise to inflation. Right now, we are seeing the S&P up by now just 0.2% and bond yields lower by less than they were lower earlier in the morning. Big discussion point around oil, not only the price and where it's headed due to some of the unrest in the Middle East, but also Exxon, close to a $58 billion deal to buy Pioneer Natural Resources, which would be the biggest deal that Exxon has done since 1999, the biggest global deal of the year, making them absolutely the dominant player in the shale patch. We're seeing now Pioneer shares up 1.7%, $241, quite a bit a ways from the $250 a share price tag that would be in this deal. You are seeing Exxon shares off just a touch. Joining us now, I'm so pleased to say, to give us a lot more light than I certainly could shed, Bloomberg's Alex Steele and Julian Lee joining us. Alex, I want to start with you. Why is this deal so important?
So first of all, $59.5 billion is nothing to sneeze at, an 18% premium for a Pioneer. This is an enormous deal. And the broader context is that this could potentially unlock shale, what people are calling shale 3.0, which would be a huge wave of M&A, big deals, big spending in the Permian, and really long laterals, which is basically the technique that you use to get a lot of oil out of shale. And that would be a very different place than we were in just a few years ago, where it was very much reducing capital spend. Interestingly enough, many analysts say that buying Pioneer is being CapEx sensitive, because it actually longer term will cost less than having to increase CapEx to keep production even level, much less growing, funnily enough.
There's a question about whether part of the reason why now this deal is happening is because regulators will be more okay with it, that actually this is going to be more amenable to both investors and to regulators because of this emphasis on energy independence and this idea of just generally focusing a bit more on the need for fossil fuels rather than the move away.
Yeah, I see it twofold. I think, one, it is going to have some antitrust issues. I think this gives a lot of fodder to the Greens in D.C. to say you're spending $60 billion on fossil fuels. You're spending, $17 billion in the next few years on carbon solutions and low carbon solutions. So there's that part. But in terms of kind of why now, I wonder, and I'll ask the CEOs this in the next hour, is this actually a Scott Sheffield thing? So Pioneer Natural Resources is like the holy grail of the Permian. Scott retired once, then he came back because they didn't like the CEO at the time, and he's retiring at the end of the year. There's also been some productivity questions for Pioneer over the last 2 quarters. It just basically means you've gotten all the good stuff out of the rock. There's more there, but the really juicy stuff has been drilled. And can you really get more out? Many say that that problem has been solved, but still, a productivity question. There was underperformance over the last few months of Pioneer versus its peers, and I wonder, and I'll ask it, if that played more of a role.
I'm wondering, Julian, from your standpoint, where the U.S. plays in the global oil sphere and how much deals like this and just generally looking for more efficiency and, frankly, record production this year plays on the global stage at a time where Saudi Arabia is trying to control supply that much more.
Yeah, I mean, the U.S. is certainly playing an important role, and growth in output in the Permian and other shale basins is going to be important. I don't think this deal sort of changes the outlook for oil prices in the short term, but potentially over the longer term, it may do. It certainly, I think, brings together contiguous acreage, acreage next to each other under a single owner. That allows for longer horizontal wells to be drilled, greater economies of scale in terms of that investment in new drilling. That could boost the prospects for Permian production and U.S. production in total. But that's probably 2 or 3 years away at least. In the short term, I think it doesn't change anything. But what it does do is mean that the shale basins of the U.S. are going to be important contributors, not just to production, but to potential production growth in the 4 to 5 years ahead.
Julian, from your vantage point, how much are deals like this made possible based on oil prices being higher, and if you have the feeling that they are going to remain so in the longer term?
Well, I think, there are many things, I think, that have factored into this deal and why now. And I think, as Alex said, the Scott Sheffield question is certainly potentially one of those. As to oil prices, I mean, at the moment, they are very much being dictated, I think, by Saudi Arabia's oil policy. They want oil prices somewhere closer to $100 a barrel than 70, for example. And they are prepared to make the production sacrifices at the moment to ensure that happens. The big question is going to be over the longer term whether they can continue to do that if demand growth starts to ease off, as people are expecting next year, and we get additional supplies coming on from places like the US, Guyana, Brazil. And so that's going to be a challenge for Saudi Arabia perhaps over the next 12 to 24 months. The immediate question is how this terrible attack by Hamas on Israel is going to play out. We saw a jump in prices followed over the last couple of days by something of a retreat. Very much is going to depend on whether this conflict spreads and starts to suck in oil producers in the Middle East, Iran being the big question mark.
Alex, your idea, just in terms of the pricing and how that factors in.
Yeah, so one analyst said that Pioneer has 6,300 net locations of high-quality inventory. That's like top-tier acreage where you get a 10% return at WTI prices 50 or lower. So, like, the last barrel produced may increase, like you might need $80 a barrel for that kind of floor, but you're buying stuff that you can make money and have a nice return sub 50.
Which is the reason why I think people are doing this. Alex, what are you hearing in terms of other deals coming down the pike to either compete with this or just that have been in the works and suddenly people are finding the reason to get it done?
So it's going to have to happen because if you're a mid-tier player, you will not be able to compete with this. So the Oxys of the world, you have Chevron, like they're going to be just fine, even though they're dwarfed a bit by this deal. But the smaller guy, I don't know how you're going to do it. And there's a lot of small mom and pop private companies as well that have already been kind of pulling back on some of their drilling, and the theory is they're doing that so then they can clean themselves up a little bit to then be bought. So we'll see how quickly it takes for that to happen.
And just real quick here, Julian, and not to pivot too much, but I would like to get a final word from you on what you're hearing out of Iran and how much further crackdown of sanctions would really influence the price.
Well, I mean, we're hearing relatively little out of Iran. I mean, there's been political support voiced for Hamas, as there very often or generally is from Tehran. We're not hearing anything yet about action against Iran or any action to try to restrict their oil exports. We've seen a fairly substantial increase in estimates of production and exports over recent months. That's been an important factor in holding oil prices lower than they would otherwise have been. And there is a challenge here that if you start going after Iran's oil exports, that is going to have an impact on the oil price. Yeah. And nobody wants higher oil prices in the consuming countries.
Julian Lee, Bloomberg's Alex Steele, thank you so much for being with us. And tune in to Bloomberg Television today at 9:40 a.m. for Alex's interview with Exxon CEO Darren Woods and Pioneer CEO Scott Sheffield to answer some of those questions. Also coming up on Bloomberg Television at 2:45 p.m., Professor Ken Rogoff of Harvard University is speaking at a time of a lot of uncertainty in the economy. We did just get that hotter than expected PPI print leading into tomorrow. We will get CPI. We are seeing a bit of of a response in markets, but no drama. We are still seeing the S&P futures up 0.3%. We are still seeing bond yields lower, now by almost 0.8%, reversing the earlier bit of a pop. This is Bloomberg.